Hello, and welcome to Session 20 of the Basic Tax course. We're going to begin Session 20 with a review of the Session 18 quiz answer key. And I have the Session 18 quiz up on the screen in front of you, and the first most frequently missed question is the first question, question number 1. You must elect to use the installment method for reporting income from an installment sale by the due date of the return for the year of sale. No. The installment method is automatic. If you do not want to use the installment method, you must elect out on a timely filed return. If you fail to file on time, the installment method is mandatory and not optional. So that is why question number 1 is false. You elect out of the installment method on a timely filed return. Otherwise, the installment method is automatic. It is not something you elect out of. Number 2, the installment method is not used if a loss is calculated on the disposition of property, even if payments are made in installments. Well, that is true. The answer to this question is really quite self-evident. If you sell property on an installment sale and you sell it at a profit, then you can use the installment method to report income from that sale as you actually receive it. But if you sell property at a loss, even if you have an installment contract with the buyer, you still have a loss, and you don't report your loss on installment. So losses are actually claimed in the year of sale, and the Form 6252 for reporting gain on an installment sale is only used when you sell property at a profit. So the installment method is not used if a loss is calculated. That is a true statement. Number 4, which of the following cannot be reported using the installment method? And we offer capital gain, unrecaptured Section 1250 gain, recaptured Section 1245 gain, or all of the above. And really, what we spent most of Session 18 hammering into you, or tried to spend hammering into you with Session 18, is that when we sell capital gain property, or when we sell an asset at a gain, we can report that gain under the installment method, assuming, of course, that we have an installment sale. But there is one kind of recapture that is not eligible for the installment method, and that is the recapture on depreciation on the sale of Section 1245 property. So if you go back to Session 18 and remember the Farmer Brown illustration, if you recall, he sold equipment and he sold his farm. And the equipment is Section 1245 property, and any proceeds he receives from that sale are not eligible for the installment method to the extent they are from a recapture of depreciation. So he has recapture of depreciation on the farm equipment that's not eligible for the installment method. He has to report that full gain completely in the year of sale. But the sale of the farm on which he has claimed depreciation is Section 1250 property, and Section 1250 gain is eligible for the installment method. So going back to question number 4 here, which of the following cannot be reported using the installment method? It is going to be recaptured Section 1245 gain. Number 5, if married taxpayers file a joint return for the tax year they sold their home, they can exclude $250,000 of gain if either spouse individually meets the ownership and use tests, and $500,000 if they both meet the use test and at least one of them meets the ownership test. Well, that's a true statement. When you have a married couple, they can exclude up to $500 of gain as long as both of them occupied the home for 2 out of the last 5 years, and at least one of them owned the home for at least 2 out of the last 5 years. And so essentially 5 is true. Question number 8. John and Betty Ford were married in September 2011. They each decided to sell their homes and to purchase a new home together. Both John and Betty meet the ownership and residency tests for their respective homes. John sold his home at a gain of $325,000, and Betty sold her home at a gain of $150,000. So what amount of gain can they exclude from their income on their joint return for 2011? Well, there's a big difference from question number 5, where we have 2 people occupying the same home. That home is sold at a gain of up to $500,000. Can they exclude it? Yes, because they both occupied the home and at least one of them owned the home, and they both occupied it for 2 years. Let's compare that to question number 8. In question number 8, there are 2 houses, and each taxpayer, the taxpayer and the spouse, own their respective homes. Neither of them has lived in each other's home, only in their own home. So we apply the test to ownership and occupancy of the home. And John has owned and occupied his home, and he sells it for a profit of $325,000. Well, the most gain he can exclude is $250,000. So he will exclude $250,000 on the profit from the sale of his home. Betty lived in her home for 2 out of the last 5 years and owned her home for 2 out of the last 5 years. She sells it at a $150,000 gain. She can exclude that gain. So the total amount of allowable exclusion is $400,000, and that is the answer. Question number 8 has the answer being $400,000. The correct answer is B. Number 9, Jerry purchased a rental home in 1996. He moved into and lived in the home from April 15, 2006 to September 1, 2010. He then rented the home again until he sold it. Jerry has not claimed the sale of home exclusion in the last 2 years. Which of the following statements is true? Jerry cannot claim the exclusion for gain on the sale of his rental property. Well, no, that's true. He owned and occupied his home for 2 out of the last 5 years. He can exclude something. Jerry can claim the exclusion for gain on the sale of property, but he must recapture all depreciation claims since 1996. Well, that's partially true. Since 1996 is not technically correct because really the date is depreciation claimed after May 6, 1997. And so, of course, then we move on to option number C. Jerry can claim the exclusion for gain on the sale of the property, but he needs to recapture all depreciation claims since May 7, 1997. That is a true statement. Now, so question number 9 is a tricky question. Let's look at what's going on. There is a rule that says if you own and occupy your home for 2 out of a 5-year period, you can exclude your gain. We also had these discussions about what happens when a home was business use and then it's personal use. Are you still allowed to exclude the gain? And as long as there is no business use after 2008 that precedes personal use after 2008, then you can, as long as you still meet the 2 out of 5-year rule in the 5-year period preceding the date of sale. So there are 2 key pieces of information we're concerned with here on problem number 9. Did Jerry own and occupy the home as his main home for 2 out of the last 5 years? Well, April 2006 through September 2010, clearly, if he sells the house at any point in 2011, he will have owned and occupied that home for at least 2 years in the 5 years immediately preceding. So he's going to win on that count. He does meet the 2 out of 5-year test. A separate test is, was there any rental use that preceded personal use and occurred after 2008? Well, there is rental use after 2008, but it does not precede personal use after 2008 because he was living in it and occupying it from 2006 till 2010. So during that whole time, it was never rented. So for the period of time after 2008, did he occupy the home? Yes, he did. He occupied it until he moved out in 2010. And then after he moved out in 2010, he started renting it again. So all of the business use that occurred after 2008 occurred after he moved out. There's no rental use after 2008 that precedes a point of time that he lived in the home. And so what that means is he can exclude his entire gain on the sale of the home. However, he's going to need to recapture or recover all depreciation claims since May 7, 1997. And now let's move on to the mini problem for the session 18 quiz. And our character in this story is Dora Explorer. She sold her vacation home to SpongeBob, and she has the following information to report on the sale. She bought the home on January 31, 2010 for $200,000, and she sold the home on May 31, 2011 for $400,000. We're asking you to complete Dora's 6252, and already we've given you the first piece of information you will need to enter on Dora's Form 6252. The $400,000 sales price will be entered on line 5 of her form. Also, we've given you a description of the property, which is vacation home, and the date acquired, which was January 31st, 2010, and the sales date of May 31st, 2011. We're telling you in the wording of the problem that she bought the home for $200,000, but there's probably some extra information we need to figure for her cost basis. And on the next page, we tell you that she had the following improvements. the new roof, the landscaping, the remodeling, and the repairs. Repairs, of course, do not add to the basis in property, but the new roof, landscaping, and remodeling do. And if we add those amounts up, we get $18,000. $18,000 of improvements added to the purchase price of the home of $200,000 gives us a cost basis in the home of $218,000. Dora has never depreciated the property, so where it asks on line 9 for an entry for depreciation allowed or allowable, line 9 is blank. Line 11 asks for the expenses of the sale. And we've told you that she had required repairs, commissions, and closing costs. When we add those amounts up, we get $30,000, and we carry those to line 11 of the form, $30,000. Then we look at how many payments she received during the year, or the amount of principal payment she received for the year. She received a down payment of $50,000, principal payments of $2,500, and interest payment of $8,000. We're going to take $52,500 and enter that on line 21 of the form. And here we have entered that right here. So essentially, we take the gross sales price on line 5, we subtract out the basis in the home of $248,000, and that gives us $152,000 of gain. We divide that by the $400,000 contract price to arrive at a gross profit percentage of 38%. We multiply that by the principal payments received for the year of $52,500, and that leaves Dora with a $19,950 gain to report under the installment method. And of course, the other $8,000 of income is going to be reported on her Schedule B. And here is the Schedule B. She's received $8,000 of interest income from SpongeBob. So that concludes the review of the Session 18 quiz answer key. Let's move on to the homework assignment for Session 19. And of course, that was Mickey and Minnie's tax return. And moving on with the homework answer key, we've got the problem itself loaded in front of you first. And again, just as a refresher, Mickey and Minnie are renting a room in their home to Goofy. And the Mouses have the following income and expenses for the year, and that the home is 30% tenant use, 70% personal use. They started renting the home back on March 1. So what that tells you is they have 10 out of 12 months of rental use, and during 10 of 12 months, the home is 30% rental use. So really the starting point with this problem is to create a table, and I've done that. You can see the answer key right here in front of you. I've got a table. And on this table, we've got the following allocations. You can see that we've taken the mortgage interest and the totals for mortgage interest. Here's the problem. Here is the total for mortgage interest on the answer key. The taxes are $3,000. You can see the taxes totaled at $3,000, and all of the other expenses are carried over and totaled on the answer key. But let's also look at some other considerations. The house was 30% tenant use for 10 months of the year, and we need to prorate the percentage of tenant use for the property for the whole year. So we take the interest, the taxes, the insurance, and the utilities, and we say, hey, there was 10 months of business use out of 12 months. So we're going to take 10 divided by 12. But then we have to look at, for the period of time that there is allowable deductions on Schedule E, how much of the house is tenant use, and that's 30%. So we essentially take 10 divided by 12, multiplied by 30%, and that gives us 25% business use that can be allocated to the interest, taxes, insurance, and utilities. We then have advertising and repairs that were made to Goofy's room. Well, those are 100% allowable. And then we have cleaning of the home after Goofy moved in. And we're going to be allowed to claim 30% of the cost of the cleaning from the point that Goofy moved in. And really down here we say cleaning and maintenance after March 1st. So $500, we're going to multiply that by 30%. But the mortgage interest, property taxes, hazard insurance, and utilities, that's going to be 25%. The advertising will be 100%. And then we've got the new roof and the new range, and we're going to have to place those in service for depreciation and claim those accordingly as well. So let's move over again to this chart to the allocation of expenses. We have 75% personal versus 25% rental on the mortgage interest, the property taxes, the hazard insurance, and the utilities. So we've entered the total amount here and divided that total amount between rental and personal. So ultimately, 75% of $10,500 is $7,875. $7,875 of interest will carry to Schedule A. $2,625 will carry to Schedule E. $2,250 of property tax will carry to Schedule A, and $750 will carry to Schedule E. On the hazard insurance, we have total hazard insurance amount of $450. $150 will carry to Schedule E, and of course none carries to Schedule A. We then have advertising costs. That was 0% personal. All 100% will carry to the Schedule E. We then have cleaning after the tenant moved in, and that is $350 for the year. 30% is tenant expense. We put $150 in the tenant column or the rental column. We then have utilities, 25% tenant expense, so we enter $500 in the tenant line. Therefore, we'll have $500 that carries to Schedule E, and of course, nothing will carry to Schedule A. And then finally, we have the repairs to Goofy's room. Those are 100% allocable to their tenant, so all $500 will carry to the Schedule E. The next item in line that we need to consider is the Form 4562. It is accepted procedure not to separate the cost of an individual asset within a home from other assets placed in service on the date the home is converted to rental use. The house is depreciable under makers using the mid-month convention over a period of 27.5 years. If the Mouses make any other improvements to the home in future years, these improvements will be shown as separate depreciation items. The combined depreciable basis of the home is shown next, and we look at the purchase price of the home, which was $90,000, minus the land value, gives us a depreciable basis of $60,000, but of course we've got the rental percentage on each of those lines. 30% of $60,000 is $18,000. We have a new roof costing $19,000. The rental percentage on that is $570. We have a range at costing $700. 30% of that amount is $210. The total basis for depreciation for the home for the year is $62,600, and the rental percentage of that is $18,780. We then need to go down and figure depreciation on the home. We take $18,780 divided by 27.5 times 9.5 divided by 12, and that gives us $541 of depreciation. And here is Mickey and Minnie's 4562. You can see that we're saying that the 4562 is carrying to Schedule E. And down on line 19H, we enter the cost in the property, $18,780. 27.5-year property under the mid-month convention gives us $541 of first-year depreciation. And here we are on Mickey and Minnie's Schedule E, and just starting up at the top, we obviously have their name. For this problem, we are also stating that they are not required to issue 1099 miscellaneouses. They don't have any expenses paid to a person or business that would require that. Then we get down to line 1, where we enter the address of the rental property. Again, we enter the type of property, which is single-family residence. Now, I've called this a single-family residence because it is a house and they're renting a room in it, but an argument could be made for multifamily, but I tend to think of multifamily as a duplex, and this is not a duplex. We then go over to line 2, where we need to enter the days of rental use. And essentially, the house was rented, or the room in the house was rented for 306 days roughly out of the year, because it was rented for 10 months of the year. And from the point the room was converted to rental use, there were 0 personal days of use. We then move on to line 3, where we enter payments that were received for the year. They were $5,500. That's first month's rent plus 10 times $500 for a total of $5,500 of rents received. Then on line 5, we enter the advertising expense. And for the other line items, we enter the amounts as we figured them on the worksheet that I just showed you. We have cleaning and maintenance at $150, insurance at $150, the mortgage interest that was paid to banks prorated for the rental is $26.25, repairs for the rental were $550, and taxes $750. We then have utilities at $500 and depreciation at $451. Now, of course, the spread or difference between the mortgage interest that is claimed on the rental property and the real estate taxes claimed on the rental property, $26.25 and $750 respectively, the difference between those and the total for the year is, of course, reported on Mickey and Minnie's Schedule A. we show $4,500 of withholding on their W-2, and we show the prorated amounts or the residual amounts that were not claimed on Schedule E. And of course, we're talking about the property taxes on the home and the mortgage interest on the home. We needed to divide those. And to the extent that we have rental use of the home, we put a proportionate amount of mortgage interest and real estate taxes on the Schedule E, but the leftover amounts go on Schedule A. And of the $3,000 of real estate taxes paid for the year, $750 went on Schedule E, and that leaves $2,250 for Schedule A. And of the mortgage interest paid, $10,500 was paid for the year, and $7,875 will go on the Schedule A. Finally, Mickey and Minnie paid $1,500 into charity during the year, and they will claim a deduction for that amount of charity paid for the year. And their total expenses listed on line 29 of their Schedule A are $16,125. Now, Minnie is also a shareholder in Pluto Inc., and we told you that she was a passive shareholder in Pluto Inc. She had losses on Pluto Inc. of $3,600 for the year. And we also have, of course, this income coming off of the Schedule E. So on the Schedule E, after we've entered all of the expenses for renting that room to Pluto, we end up with a net profit on the Schedule E of $134 for the year. We also have to consider this passive activity from Pluto Inc., where we have a $3,600 loss for the year. So, of course, we need to go over to the passive activity loss limit form, Form 8582, and on it we need to enter income from the passive activity. That's $134 of income from renting the room to Goofy. And then on line 3B, we enter the loss from passive activities, and that's a $3,600 loss that goes on line 3B. Therefore, we're going to have a $3,466 carry forward to 2012 and $134 of passive loss that will be allowed for the year. So we carry the $134 of passive loss over to Schedule E, page 2, and enter that under the passive column, column F, $134. We have $134 that we then carry to line 31 and line 32. Line 41 is 0 because the profit from page 1 of Schedule E is balanced out by the loss on page 2. We have net income for line 17 of the 1040 of $0 for the year. And moving back to Mickey and Minnie's 1040 return, we have Mickey and Minnie who are filing a joint return with 2 exemptions. The W-2 is $51,000. They have no net income or loss reported on line 17. And on page 2, on line 40, we enter their net itemized deductions of $16,125, their personal exemption deductions totaling $7,400. They have taxable income of $27,475 and tax of $3,271. They had $5,600 withheld, and that leaves them with a $2,329 refund. And that concludes the review of the Session 19 homework answer key. It is now time to push pause on video playback and take the Session 19 quiz. When you are finished taking the Session 19 quiz, please resume video playback for the Session 20 lecture. So again, thank you and welcome for joining us today at our apex of our series, you could say, is self-employment. I call it the apex or the summit or the top because everything we've been learning in our education series, the 1040 CPE series, has been leading to this day, to a point where we've been building on content to get to a point where we are going to do the mother of all tax forms in terms of the 1040 form, which is Schedule C. Now, Schedule C, in and of itself, isn't that horrendously complicated. It's got lines, it asks you to put numbers on them, and that seems to be rather elementary. But there's a lot more to Schedule C than putting a few numbers on the lines, and clearly one of them is, am I allowed to put a number on the line? How do I calculate the number I put on the line? But more often the complexity with Schedule C arises from all of the external things going on around it, such as additional forms that might need to be attached to Schedule C, like 4562, 8829, Schedule SC, 4797, and the list goes on. I'll actually show you how long that list can be in a couple of minutes. So with that, I'll show you the reading assignment for today. And 334, publication 334 is the IRS's tax guide for small business. There's a lot of really interesting stuff in there. If you sit down and actually read that publication cover to cover, you will learn a lot. And then there is also the Farmer's Tax Guide, publication 225. Now 225 is an interesting publication because obviously it talks about Schedule F and some of the special rules for farmers. But one of the things I've noticed about publication 225 is it actually covers a lot of things that are already covered in other publications. It's a publication directed at farmers and self-employment around farmers, but when it talks about self-employment around farmers, it also talks about depreciation and many other aspects that are already just a general part of self-employment to begin with, and things that we've talked about earlier in our series. I'm going to move down to the second page of the manual now. And if you have printed the manual and you have it, you can just flip along and follow with me as I go, make notes as you go. If you want to be able to print the manual and haven't done so, you can actually, when we come to a break, go do that. Ask me how to do it and I will tell you. So we've kind of started with an overview already by saying that the Schedule C, or self-employment, is among the most complex forms of income you will need to report on your tax return, and that when you file Schedule C, or when you report self-employment income, you will need to report your income on at least one form and probably many other forms as well, or at least one or two or several other forms. So let's go through a list of all of the forms that are known to be associated with self-employment, starting with Schedule C itself, which is the profit or loss from business, followed by Schedule F, the profit or loss from farming. Then, of course, we have Schedule SE, which is prepared for self-employment tax. If you're qualifying for a business credit, then you would need to attach Form 3800, General Business Credit. And then the next one, the big one, is Form 4562, Depreciation and Amortization. And I'm going to talk or mention depreciation ever so briefly today, but today's class is not going to really cover how to figure depreciation or any of the rules surrounding depreciation, because we spent 6 hours doing just that in our course called Depreciation Made Easy. So if you have depreciation questions, that's the place you need to go. Then we also talk about, or we don't talk about, but we have previously in our series talked about Form 4684, casualties or thefts. That form can also attach itself to self-employment. Form 4797, sale of business property, in our sale of assets course. Form 1040 ES, estimated tax for individuals. When you're self-employed, if you're actually making money at it, making a living at it, you've got to pay your taxes. And the IRS doesn't want you to mail your taxes with the tax form 1040. They want the taxes throughout the year. And you, of course, pay your taxes quarterly through 1040 ES. Then we have Form 8829 for business use of home. We're definitely going to take a look at that baby today. And also the Disabled Access Credit, Form 8826. If you have a business and you make improvements to property that you use in your business to adapt it to uses that make it more accessible for handicapped individuals, you can qualify for a credit for that. We don't cover that credit in today's class, but we will be covering that credit in our course called Federal Tax Credits for Business. The next one is Form 8594, Asset Acquisition Statement. In the year you buy or sell your business, you need to file this form with your tax return, and we did talk about that in our class called Sale of Assets. Then we have Form 8824, Like-Kind Exchanges. We talked about that just earlier this week in our course on like-kind exchanges. Then we have Form 8846, Credit for Certain Employer Social Security and Medicare Tax on Tips. And then we have Form 8903, the Domestic Production Activities Deduction. We will talk about that today, who qualifies for it, how to fill that out. Form 941, Employer Quarterly Federal Tax Return. If you have employees, you need to be paying your payroll taxes on them, and that's the form you use to do it. And then Form 940 is the Federal Unemployment Tax Form for employers. Next, we have a Form W-3, Transmittal Wage and Tax Statements, and it goes hand in hand with the W-2 wage statement. If you have employees, you need to file W-2s and the accompanying W-3 transmittal slip with them. There's also Form 1096, Annual Summary and Transmittal of U.S. Information Returns. That attaches to Form 1099, Miscellaneous Income. And although we're not going to spend any time today really talking about the wage statements that employers need to issue, we are going to spend quite a bit of time talking about 1099 Miscellaneous Income, because 1099 miscellaneous income goes hand in hand with self-employment. Two directions. One direction is I'm self-employed and I might get a 1099, and the other is I'm self-employed and I pay independent contractors to provide services for me and I need to 1099 them. Either way, you're either on the receiving or the giving, and sometimes both ends of the 1099 process, so I think that's a big topic that we're going to spend some time on today. And of course, we have the big form itself, Schedule C. We're going to spend the majority of our time today talking about this form, and basically, line by line, we're going to look at it. How you fill it out, the reasons that items are entered on each line, how you figure the items, that's really the scope of today's class. Now, the form itself should be filed if either of the following is true. You have net earnings from self-employment that are $400 or more, or you have received a 1099 miscellaneous reporting income of $400 or more in box 3, other income. So essentially, IRS says you're required to file Schedule C and report self-employment tax if you have a profit from your business. And even if you don't have a profit from your business, you probably should file anyway if you have a 1099 miscellaneous that you've received, because the IRS has no idea what your expenses are until you file the 1040 with a Schedule C attached to tell them what your expenses are. Now, the first thing in line we have here is something called a husband-wife qualified joint venture. The IRS created this category a few years ago. It's fairly recent history. And as you might imagine, it would be a pretty common thing for a husband and wife to run a business together. And the very nature of Schedule C is that the title on it is sole proprietor. And you're not sole if there's two of you. And so when a husband and wife went into business together in the past, it was deemed to be a partnership. Now, you could have a different kind of relationship where one spouse owns the business and the other spouse works as an employee for the owner of the business, the owning spouse. And in fact, when I first got into this business 20 years ago, that's exactly what happened. I started up a tax business, and I hired my husband, and I paid him, and he got a W-2. And that's completely fine. And back in those days, the only other option would have been to have a partnership, because they didn't have qualified joint ventures back then. But along the way, the IRS came up with this concept, or our federal government came up with this concept of a qualified joint venture. And what happens under that is the husband and wife are each allowed to file separate Schedule Cs. There's no such thing as a joint Schedule C. You can't have husband plus wife on the same Schedule C. IRS does not accept that. But what they will accept is two Schedule Cs where each spouse files their own Schedule C and divides the income and expenses between them on their own separate Schedule Cs. There is a procedure for doing it, which is not very complicated. And in the past, the husband and wife may have been filing partnership returns and have made a decision to just do qualified joint venture, and it's actually perfectly legal to do that. You can switch from a partnership to a qualified joint venture with two Schedule Cs on the return, and IRS says you make the election simply by doing it, but once you've made the election to file under a qualified joint venture with two Schedule Cs rather than a partnership return, you have to stick with that. You can't be going back and forth one year for 1065, the next year two Schedule Cs, then back to 1065. They want you to stick with it. Now, it could be the case that there comes a year where you don't file together or on a joint return, and therefore you would be forced to go separately. So let's take a look at making the election and how it works. To make the election, you must divide all items of income, gain, loss, deduction, and credit attributable to the business between you and your spouse in accordance with your respective interests in the venture. Now, if they're saying, oh, it's exactly 50-50, then it would be relatively easy. You could probably have one profit and loss for the whole business, divide everything exactly down the middle, and you're done. But IRS is actually providing for the possibility that it could be something other than 50-50. But whatever it is, you need to figure it out. And then you enter it on the tax return. Once you have made an election to file as a qualified joint venture with two Schedule Cs rather than a 1065 partnership return, the election can only be revoked with the permission of the IRS. However, the election technically remains in effect only for as long as the spouses filing as qualified joint venture continue to meet the requirements for filing the election. If the spouses fail to meet the qualified joint venture requirements for a year, a new election will be necessary in any future year. Now, by making the election to file as a qualified joint venture, there is a bonus. If you could call it a very small bonus, it's rather minor, but it is a bonus, and that is that no EIN is required. If you form a partnership with your spouse and you file Form 1065, you have to apply for an employer identification number so that the 1065 can be filed. Under a qualified joint venture, it is not necessary to have an EIN for either spouse. They can just use their own Social Security numbers on the return. Of course, if they have employees, they would still need an EIN anyway. And here is the Schedule C. It's got lots of sections. I like to break forms down into their sections and study them line by line. This is an interesting line. B, enter code from instructions. What instructions? Well, I like to read those instructions. I get kind of excited when I see instructions. I enjoy stuff like that. So you get to share in my excitement. We'll look at those instructions for the code. Would you like to do that today? And then EIN. Whose EIN? My EIN? Do I have an EIN? How do I get an EIN? We'll talk about that. Accounting method? What's an accounting method? Well, there are different accounting methods out there. How do I know which box to check for my client? And then, did I materially participate? What does that mean? Need to answer that question, so we'll talk about that. And then, did I start the business during the year? Is this the first year? I think that's probably the simplest question on the whole form. Is this my first year in business or is it not? I don't think I need to spend any time answering that question. Items I and J, those are new this year. They've never been on the form before. Did you make any payments in 2011 that would require you to file Forms 1099? And if you were required, did you? So we're going to spend some time talking about who is required to file these forms and how to file the forms. And not only that, what happens if you file the forms wrong, you file them late, you file them not at all? What happens in those events? We're going to spend some time talking about that. Then we'll move on to income, and the income section is even interesting. We've got line 1A, merchant card and third-party payments. Line B, gross receipts or sales not entered on line 1A. Income reported to you on a Form W-2 for a statutory employee. Add them all up, total gross receipts. And then returns and allowances plus any other adjustments. What do they mean by that? We're going to take each of these lines in turn today. Moving down into the expenses, we'll look at each of these in turn today as well. And even down to these lines here, 32A and 32B, investment at risk. How do we know when to check those boxes? On page 2, we move into part 3 with cost of goods sold. We'll definitely take a look at that and how you determine the method for inventory, how you figure your cost of inventory, your cost of goods sold. Information on vehicle, we will talk about the rules for reporting auto expenses on Schedule C and how to complete this section. In certain situations, you are not allowed to enter your auto expense in this section and must attach Form 4562 instead. So we'll talk about that. And let's begin at the top. Schedule C, page 1. We're going to take a look at this section first. Items A through E, you could say. And on line A, it says, enter the principal business or profession, including the product or service. It also has the name of the proprietor, of course, just above it. You describe the business or professional activity that provides the principal source of income that is reported on the income lines 1B through D. So this is a business. I have income. I've reported. What is the principal source of the business? If you owned more than one business, you must complete a separate Schedule C for each business. And this is a question my clients give me sometimes. Can't I just, I do this business, I do that business. Can't I put them both together? And IRS doesn't want you to do that. Sometimes for practicality purposes, it happens anyway, but IRS prefers that you keep businesses separated. You need to give the general field or activity and the type of product or service. And if your general field or activity is wholesale or retail trade or services connected with production services, such as mining, construction, or manufacturing, you should also give the type of customer or client. For example, wholesale sale of hardware to retailers or appraisal of real estate for lending institutions. So they're rather specific about what they want you to say there. Now, when you're working in tax software, it usually gives you a certain amount of space to type your description in, and then you run out of space and you're done. It doesn't seem to me to be that big of a deal what you put in there. But it is interesting how IRS uses the information on the front of the form to actually select people for audit. So I try to be as precise as I can. I've had clients selected for audit. The first client I ever had who had a small business that was selected for audit was audited because she owned a coffee shop. That was the only reason they were auditing coffee shops. Schedule B, or not Schedule B, but item number B, enter the code from pages C9, 10, and 11. Well, C9, 10, and 11, those are the instructions for Schedule C. So if you actually go to the IRS website, irs.gov, and do a search for the Schedule C instructions, and you get to them, on pages 9, 10, and 11, they have codes. And I've pasted them in here for you. These codes are for the principal, business, or professional activity, and they are used to classify sole proprietorships by the type of activity that they are engaged in. And the reason the IRS wants you to put the code on there is to facilitate their administration of the Internal Revenue Code. Now, one of the things I can tell you goes on is that they have these computer systems out there that are processing data all the time. And they have certain parameters that certain businesses are expected to fall into. And clearly, if you file a tax return with a particular business code and your tax return is showing numbers that are dramatically skewed one way or another, that's going to be one of the systems that they have in place to kick that return out for potential review. Now, last fall, I was at a IRS forum here in Portland, Oregon, and one of the speakers was a lady who runs the Portland, Oregon examining office. She's the lady that decides how tax returns are selected for examination, and she actually talked a little bit about the process that they go through. And it starts with a computer kicking out a potential return, basically kicking out a return that has been filed, and then it comes to her desk and she makes a decision, or her office makes a decision about whether or not they're actually going to audit that return and what lines on that return that they're going to audit. So from our standpoint as tax preparers, one of the things our clients want is to not be audited, right? So I feel that accuracy on these top lines and doing a good description of the business is important, just because it helps make sure, at the very least, the tax return is pegged into the correct category, the correct statistical database is going to be analyzing it, and that it's not going to be analyzed with other businesses that are not remotely similar because we categorized it incorrectly. So we want it to be categorized correctly for that reason. But she did go on to talk about how they select it, and some of it's random, just the computer kicking it out, and some of it from that point forward is a human eye looking at it and thinking, this does look a little strange. This one's going to get a letter. Or it could be, no, there's nothing that unusual about this. Computer kicked it out, but it's not worth our time. And that's the kind we want as tax preparers. We want the one where it got looked at it and it wasn't worth their time. And no one even knows that it was even considered for examination. It was just rejected from the potential pile and they moved on. So what the IRS wants you to do, and here's their instructions. This is from the Schedule C instructions for this particular line. Enter the code. Select the category that best describes your primary business activity. For example, real estate. Then select the activity that best identifies the principal source of your sales or receipts. For example, real estate agent. Now find the 6-digit code assigned to this activity. For example, 531210, the code for offices of real estate agents and brokers. And then enter it on Schedule C, line B. But note, if your principal source of income is from farming activities, you're in the wrong place. You're supposed to be filling out an F. All right, so let's just take a look at some of these business activities. Now, I used to joke about the fact, when I first got into this business, that there was no category for tax preparers. We had no category. The closest you could get was accountant, and a tax preparer, I think, is a very different animal than an accountant. And we didn't have a category. But here we have accommodation, food, services, and drinking places, administrative support and waste management remediation services, agriculture, forestry, hunting, and fishing, arts, entertainment, and recreation, construction of buildings, and all the different types of contractors who might be working in construction. On the next page, we have educational services. And that's kind of there's only one choice. It doesn't seem to matter whether you're a huge university or a small Pacific Northwest tax school. Either way, it's the same code. And then finance and insurance, healthcare and social assistance. So we can see all of the different types of medical practitioners out there, each of them having their own type of code. Then we move up to hospitals. Moving over into information, we look at broadcasting, data processing services, motion and sound recordings, motion picture and sound recordings. We move into manufacturing. That's quite a good size category. They want to know what kind of manufacturing the business is in. Food manufacturing is separated from other kinds of manufacturing. They also have a category for mining, And then we get into services. Now, somewhere in here, I would expect there would be a tax preparer. Find it? Professional services. So we have services, and then we have professional services. Thank you, class. So right here, 541213. Let's hope we can get the correct code on our tax return. Now, of course, some of my attendees might be CPAs, and somewhere in here there's going to be an offices of certified professional accountants. So they've separated CPAs from other types of tax preparers now, and also you can have people who are other accounting services but not CPAs as well. Real estate, that real estate agent must be in here somewhere. And then we have, we have something for religious groups, retail trade, all the different types of things you might be selling. Car dealers are separated from other kinds of retail items. Then we have transportation, that would be trucking firms, couriers and messengers, utility companies, wholesale trade, and then finally the 9999999er, unable to classify in any way whatsoever. I used to see 999 a lot when I looked at tax returns. When I for the early years I was in this business, it seemed everyone was always putting 999 on things, but they didn't seem to know what to do, or they were too lazy to look it up. But it isn't that hard to put something in a category. 999 is a last desperation. You just really couldn't find anything else. All right, so then we're moving on to the next line, which is business name. If you do not have a separate business name, you would leave it blank. So let's look at a reason why you would have a separate business name. One of the first reasons you might have a separate business name is that you have registered as a DBA, and DBA meaning doing business as. And if you are doing business as, you typically have to register with your state in some way to reserve that name and have the right to use it. You always have a right to operate under your own name. So if you have a lady named Joanne Smith, and Joanne Smith wants to open up a business, she can open up a business in her own name, Joanne Smith, and operate that way, and that's fine. She can do that. But if she wants to operate under Joanne's Fabric Softener, well, that would be an assumed business name. She would need to register it. She can register the business name and have the right to use it, and if she does that, then she would put that on her tax return. Or she might decide to form an LLC. And a single member LLC is a disregarded entity. What a disregarded entity means is you've created an entity at the state level, but it's not recognized for tax purposes. So a limited liability company is a method of forming a business entity without actually having an entity. It's counterintuitive. It's difficult to describe because it's so different than a corporation. Back when I was in college, in my very early days introduction to corporate law, it was a very simple thing. When you form a corporation, you're forming an entity. You're forming something that exists separately under the law. It can own property, it can sue, it can be sued. When you form an LLC, you're not forming an entity like a corporation. It's kind of this loose thing, and really the LLC is nothing except what it's made up of. And if the makeup is a single person, then the LLC is taxed as a sole proprietor. There's no partnership form to file, there's no corporate form to file, because as far as the entity is concerned, that limited liability being created who has only one owner, the IRS says there is no separate entity. We're going to disregard it, pretend it doesn't exist, you're a sole proprietor, and that's how you'll file. So if you have gone ahead and formed an LLC, and many small business owners do that, they hear it's a good idea, they just hear it around, they think they should do it, so they do it. They form this LLC, and then they think that their tax situation has changed in some way, but it almost never has changed. Almost never. In California, if you form an LLC, you're in trouble, because if you form an LLC in California, or if you do business as an LLC in California, even if you formed your LLC in another state, California has a minimum filing fee of $800 in a form that has to be filed. So in most states, the creation of an LLC has no impact at the state level either, for at least tax-wise. California is a major exception, and there could be some other states like that as well. But in the state of Oregon and most of the country, when you form an LLC and you were the only owner, that's it. You're going to file Schedule C. Nothing special. As if you'd done nothing at all, except you're going to put the name of your business, your LLC, on the name line, line C. Next line is line D, employer identification number, or EIN, if any. Now, it used to be in the olden days that the only way you were ever given an EIN is if you were going to have employees. That's why it's called an employer identification number, because the IRS issued it to employers so that employers could then put that number on the W-2s that they handed out to their employers and also on the payroll reports. But as time has passed, more and more people have become concerned about identity theft. They're being asked to turn over their Social Security number to vendors that they do business with, or they are a vendor doing business with others, or they are a service provider and they're being asked to provide their Social Security number and they don't want to give it. They're refusing to give it. And so IRS, some time ago, in the last 10 years, really had to change the way it thought about EINs and really start issuing them to people who didn't have employees. And so if you are a small business owner and you don't want to be handing out your Social Security number to people you do business with, then an EIN is a good way to go. And even if you don't have employees, you can have one. So how do you apply for one? Well, in the olden days, you picked up the phone and you telephoned, and you talked to people over the phone, or you filled out a form called SS4 and mailed it in. In modern times, you simply go to the IRS website, click on the link, and apply for it right there online, and it takes seconds, and you will have that identification number. Business address, complete this section if you have a dedicated business location that is not inside your home. Now, I find no guidance about business address on the IRS website other than if you have one, put it in there. But what I can tell you, my experience has been, when a client gets audited, there's two different ways the IRS can go about auditing you. One of the ways they audit you is they send you a letter and they tell you to make an appointment to come down to their office. And here in Oregon, it's the 6th floor of the federal building, right? So, and it's not a very nice place. I've been in it a few times and sat there with my clients. And anyway, I don't really care going down there. The other kind of audit is the auditor comes to you. And I've been told that the difference between when they come to you and when they don't is if you have a business location. So that if you are selected for an audit on your business and you have a business location, that they will send an auditor out to that business location. But if you are just working from your home, you're probably going to be asked to go down and visit them. So if you have a business address, you should put it on the form. Because if you have a choice between being audited at your business location or going downtown, I can tell you that having them come to you is much better. The experience level of the auditor, the quality of the auditor, you could say, how smart they are, improves. That's been my experience. All right, accounting method. We'll spend a little bit of time talking about accounting method. This is a more advanced topic. If you're like me, you may not have really taken accounting. There are people working in the business like me who are not accountants. I took a couple of accounting classes in college because I thought maybe I would follow that path, but I ended up graduating with an arts degree in mass communication, and what accounting class I ever took, I don't remember learning about accounting method. It wasn't covered. It probably was covered, but it went right over my head at the time, right? So we get into the tax return world, and by and large, most of the clients we ever deal with are individuals, and they file cash basis. We file them cash basis, and we really don't even think about any other way of filing. But there is actually another way to file, and when you're dealing with businesses, you have to be really aware of the two different systems and the rules behind them. So we're going to spend a little bit of time talking about them. So you figure, or you are required to figure your income, your taxable income, and file an income tax return for an annual accounting period called a tax year. Also, you must consistently use an accounting method that clearly shows your income and expenses for the tax year. An accounting method is a set of rules used to determine when and how income and expenses are reported. You choose an accounting method for your business when you file your first income tax return that includes a Schedule C for the business. After that, if you want to change your accounting method, you must generally get IRS approval. So we're on this line right here, F. And what does the line tell us to do? We have a choice. Check the cash box, check the accrual box, check the other box, and specify what we're doing. So we're going to talk about those. The kinds of methods. You must use an accounting method that clearly shows your income. And generally, you can use any of the following accounting methods: the cash method, an accrual method, a special method of accounting for certain items of income and expenses, or a combination method using elements of 2 or more of the above. You must use the same accounting method to figure your taxable income and to keep your books. So, accounting method is all fine and dandy if your client even has a method. So as a taxpayer, we sometimes are going to be making that choice for them, right? And it's probably going to be cash because their mind is going to be thinking cash in most cases. They're going to come in with their bag full of receipts, and you're going to add them up or help them add them up. And you're going to be looking for receipts that don't belong in the current year. I've watched IRS auditors do the same thing. They're going through receipt after receipt after receipt, and they're pulling ones from the wrong year. They're well trained to do that. They don't just see a number on a receipt and add it in. They're trained to look at every date. So we should be looking for dates as well. So cash method is where we're going to start because that's where most of the small business owners find themselves because they're not savvy enough or sophisticated enough to even have any other system of accounting other than cash. So most individuals and many sole proprietors who do not maintain inventory use the cash method because they find it easier to keep their records. However, if inventory is necessary to account for your income, you are generally required to use an accrual method of accounting for your sales and purchases. Now this requirement is a very loose requirement, I like to say, because the vast majority of businesses out there are exempt from the requirement because they're too small. You have to have a pretty sizable business going, a real going concern, a good-sized going concern that's been around and people have heard of it. You know, if it's a business, you know, with a big building on the corner and it's been there for 30 years and everyone knows who they are, they're probably going to be required to use the accrual method because they're big enough. But most businesses are much smaller than that. Now let's look at income. Under the cash method, you include in your gross income all items of income you actually or constructively receive for your tax year. And you have to work on constructive receipt and think about that as well. You have constructive receipt of income when an amount is credited to your account or made available to you without restriction. You do not need to have possession of it. For example, interest is credited to your bank account on December 2011, but you do not withdraw it or enter it into your passbook until 2012. You are required to include it in your income in 2011. Also, you're not allowed to delay the receipt of income deliberately to push it from one year into the next. If you have access to the money, you need to report the income. So for example, a check comes to you in the mail in December and you decide not to post it or put it into your bank account until January. Will the IRS know that you got it in December and not in January? Probably not. But you know, if the check is dated November 1st and it clears your account on January 15, they might pick up on that. They're smart enough to do that. Expenses. Under the cash method, you generally deduct expenses in the year in which you actually pay them. This includes business expenses for which you contest liability. Expenses paid in advance. Under the cash method, you can deduct any expense you pay in advance only in the year to which it applies. For example, you are a calendar year taxpayer and you pay $1,000 in 2011 for a business insurance policy that is effective for 1 year beginning July 1. You get to deduct $500 in 2011 and $500 in 2012. Well, that's complicated. Who can remember that? Not your typical small business owner. Accrual method. Under an accrual method of accounting, you generally report income in the year earned and you deduct or capitalize expenses in the year you incur them. The purpose of the accrual method of accounting is to match income and expenses in the correct year. So what the IRS means by that is, let's just suppose you receive an order in to manufacture a photocopier. Your business is photocopying and you do custom photocopiers. I'm sure that doesn't happen, but it just popped into my head as an idea. So you get the order in to manufacture this photocopier. The order arrives and you're going to build this $20,000, $30,000 machine. And you have all of the costs that you incur in the production of that machine. The machine is finally finished and it's delivered. And under the accrual method of accounting, at the point where that machine is finished and delivered, you would now account for all of the costs associated with manufacturing that machine. And at the point it's delivered, that's the point where you are now due to be paid for it. And the IRS wants to see under the accrual method that the income from the production of that machine and the costs related to the manufacture of that machine are tied together and not split into separate years. It's considered to be more accurate. And in terms of a business trying to track how profitable it is, it's clearly a more accurate way of tracking how profitable your production really is. But that kind of accounting is going to be far more complex and far beyond the capacity of most individual business owners, most small business owners. And it's probably beyond the capacity of many tax preparers as well to even comprehend or track it. So it is more advanced type of accounting, and that's why the IRS says that only larger businesses have to follow it. Yes? There's a question in the classroom, is this basically saying that at the time it becomes an account receivable, is that when it becomes income in the year? And that's exactly what it means. So by the same token, under the accrual method of accounting, if you've accepted delivery of an item, you are allowed to claim the cost of that item in your expense ledger, that you've paid that expense out even though you haven't. So you're allowed to claim an expense under the accrual method even if you haven't paid it, as long as it's due. You owe it. It's currently due and you owe it, but you haven't paid it, you still get to claim it. And by the same token, you've finished that photocopier, you've delivered it, you've billed the account, the money is owed to you, but you haven't received it, you're going to say that you did in the books. So let's look at a couple of illustrations here for expenses under the accrual method. Under an accrual method of accounting, you generally deduct or capitalize a business expense when both of the following apply. Number one, all events test has been met. The test has been met when all events have occurred that fix the fact of the liability, and the liability can be determined with reasonable accuracy, and economic performance has occurred. And there's an example. You are a calendar year taxpayer and use an accrual method of accounting. You buy supplies in December of 2011. You receive the supplies and the bill in December, but you do not pay the bill until January. You can deduct the expense in 2011 because all events that fix the fact of the liability have occurred. The amount of the liability could be reasonably determined, and economic performance has occurred in that year. Your office supplies may also qualify as a recurring expense, and in that case, you can deduct them in 2011, even if the supplies were not delivered until 2012, when economic performance occurred. Combination method. You generally can use any combination of cash accrual and special method of accounting if the combination clearly shows your income and expenses and you use it consistently. However, the following restrictions apply. Number one, if an inventory is necessary to account for your income, you must generally use an accrual method for your purchases and sales, but you can still use the cash method for everything else. If you use the cash method for figuring your income, you must also use the cash method for reporting your expenses. And if you use the accrual method for reporting your expenses, you must also use an accrual method for figuring your income. It's not hard to figure out why they'd want that rule. If you use a combination method that includes the cash method, treat that combination method as the cash method. So for example, if you're predominantly a cash method tax filer for your business, but you use the accrual method for inventory only, you would call yourself cash. That's what they want you to check. Change in method. Once you have set up your accounting method, you must generally get IRS approval before you can change to another accounting method. A change in your accounting method includes an overall change in the overall method, such as from cash to accrual, and the treatment of any material item. It's not just like you check the cash box one year and the next year you go, oh, I'm going to switch to accrual. The IRS doesn't like that. If you want to switch from cash to accrual or accrual to cash, you have to file a form, Form 3115, Application for a Change in Accounting Method. And when you do that, you have to account for all of the differences to make sure that moving from one year to the next, you don't somehow lose income that you don't pay tax on. So if under the cash method, you realize a $10,000 profit in a year, and you file under that method, but if under the accrual method, you would have realized an $11,000 profit, so the next year you switch to accrual, and that $1,000 that would have been in the back year has disappeared because you're going accrual in this year, you're going to have to account for that on the change of accounting method form. Now, one of the things I have noticed is lots of my small business clients do hire bookkeepers who use QuickBooks. And the thing with bookkeepers is they're a little bit like tax preparers. Sometimes you have a good one, sometimes you have a bad one. And when you have a bad bookkeeper, it's really, really scary. You know, that QuickBooks software is $100 off the shelf at Costco, and it does nice looking reports. You get these reports that print out and they look pretty professional until you actually start looking at the numbers. And the numbers can be really, really kooky. This year I had a client, he's been my client forever, and he's kind of one of those clients that you want to fire. I want to fire, but he keeps coming back. And I'm not even that polite to him anymore. He never wants to pay for good bookkeeping. That's his problem. You know, he could come and pay us to do it right, but he doesn't want to pay us to do it right because we actually charge enough to make a living at what we do, and his stuff's a mess. So he finds these people to do his books for him cheap. And this year he came in with a P&L, and I know this is his only business. I know he has no other source of income unless he's dealing drugs on the side. I don't get the impression he is. I think he's making a living off his business. And every year it's a loss. It's like, okay, so what are you living on? This is the question I have. What are you living on? I mean, what are you buying your food with? What are you paying the gas with? What are you paying your rent with? What are you living on? Because this business is showing a loss. Are you taking home any money each month? Oh yeah, I average, you know, $1,200, $1,500 a month that I'm taking home. Well, you can't have a P&L that says you lost $3,000 if you're taking home $18,000 a year. Okay, so this is the conversation I have. And so then I start looking at the P&L and I see these items on here. What is that? You know, it's just this big number. It's like, where did that number come from? I don't know. My bookkeeper put it there. Okay, so I send him on his way and I say, Mr. Client, you're going to need to fix this P&L. I cannot work with this, or you're going to need to give me the QuickBooks disk so I can go in and fix it to do the tax return. I can't prepare a tax return based on this. It's just garbage. So I send him on his way, and he's grumpy about it. He's hoping I'll just do his tax return based on this P&L. And as I said, I don't know why he keeps coming back. I'm just refusing to do it, and he needs to find someone who doesn't know what they're doing, I think. So he's got a bookkeeper who doesn't know what he's doing, and the bookkeeper calls me, and the bookkeeper's feeling very frustrated because he's worked very, very, very hard on my client's books. He's put days and weeks into them. He thinks that they're great. And this is a retail clothing establishment, folks. And I said, firstly, you printed out an accrual method report, because QuickBooks defaults to accrual, you know. And he's cash. I need it to say cash. Well, I don't want it to say cash because it shows him with a profit when I print it cash. So the bottom line is this man still has not come back with books that I will work on. I still have not prepared his tax return for the year. But this is the type of thing we as tax preparers should be on our toes with. I mean, the very nature of QuickBooks is that we know it defaults to accrual, and if you want a cash basis report, then you're filing cash basis, the QuickBooks report needs to be generated cash. And this is assuming QuickBooks is remotely accurate to begin with, and I can assure you that of all of the tax returns I have ever prepared, where I've ever analyzed a QuickBooks report based on tax law, because I don't look at QuickBooks as an accountant, I look at QuickBooks as a tax preparer, and how I'm going to take numbers on that QuickBooks printout and put them on a tax return. And the numbers on it are never correct. Now, they might be close to correct, you know, within a few $100s or a few $1,000s where I need to make adjustments, but they're never 100% correct. So I never assume QuickBooks is correct, and what I like to do is see basically the backup so I can go in and pry into it. So when we get into this issue of cash or accrual, you need to select a system and stick with it. And most filers are going to be cash, but a few are going to be accrual. And if they are accrual, as a tax preparer, I want to know that they actually understand what accrual means, that they're keeping their records truly in accrual fashion. And once the accrual system is selected, you have to stick with it. Or once CAS is selected, you have to stick with it. And if they need to change from one to the other, there needs to be that 3115 form done for that. Okay, so the question from one of my webinar attendees is, can we use the cash method when we buy with a credit card? That's actually an interesting question. Here's how the IRS deems debt. You have incurred an expense and you have paid that expense, even if you borrow money to pay it. So at the time you go into a store and you make a purchase, whether you purchase that item with cash or a check or a credit card, as far as that vendor is concerned, they've been paid, unless, of course, the check's bad, right? And as far as the IRS is concerned, you've paid it. The fact that you owe money to the credit card company changes nothing. You've created a liability of the credit card company, and that liability is a completely independent issue from the expense itself that was paid for using the credit card. So the expense is claimed in the year you incur and pay that expense, not in the year you pay off the credit card associated with it. The next question is, so charge him for fixing his books and run the rule that says 3 out of 5 or hobby, he will leave. Yeah, I agree, Sue. He's just one of those ones that's been around forever. But yeah, I'm ready to fire him politely by making it impossible for him to use me. Password number 1 is Kai, K-A-I. Okay, so material participation is the next thing we're going to talk about because we're on to question number G. Did you materially participate in 2011? Yes or no? What does that mean? Well, our last class we talked about rental activities and passive activity loss limits, and we talked quite a while in that class. We spent about close to an hour talking about passive activities, or more than an hour talking about passive activities. Today we're just going to touch on it. But material participation is the defining phrase of whether or not you are passive or non-passive. And generally, you are considered to be materially participating in your business if you or your spouse did the majority of the work in your business, or you worked more than 500 hours in the business activity for the year. Even if you worked 500 or fewer hours in your business, you may still have been considered to be materially participating. The IRS has a series of 7 tests that you go through to determine whether or not you are materially participating. If you pass any of the tests, you can check the yes box. That's a very important thing, because if you materially participated in your business income and losses are considered to be non-passive. This means your income and losses from the business can be used to offset other forms of non-passive income and losses, including income from wages, interest, dividends, and capital gains, pensions, annuities, and other forms of retirement income, alimony, unemployment, and basically any other form of non-passive income. In other words, all of these income types are non-passive, and when you have a business that you are materially participating in, your business is considered to be non-passive. The opposite of non-passive is passive, and you are passive when you have no material participation. If you did not materially participate in your business is considered to be passive. If your business is passive, your losses can only be offset by income from other passive activities. A passive activity is a business or rental activity in which you did not materially participate. There is an exception here for oil and gas. If you are filing Schedule C to report income and deductions from an oil or gas well in which you hold a working interest directly or through an entity that does not limit your liability, check the yes box. The activity of owning a working interest is not a passive activity regardless of your participation. Limit on losses. Your loss may be limited if you check no to the box on line G. If you check no, you will need to complete Form 8582 to figure your allowable loss. That is if you, of course, have a loss. And if you have a loss, if you have a profit, you may still fill out 8582 if you have other passive activities that are losers, because you've got passive, you've got passive. If you have a loss on one and a profit on the other, they can offset each other. Lines I and J are what we're up to now. I, did you make payments in 2011 that would require you to file Form 1099? And line J, if yes, did you or will you file all of the required Forms 1099? For tax year 2011 and future years, I and J have been introduced regarding required filings of Form 1099. This is because the IRS is stepping up efforts to enforce compliance on businesses that are required to but fail to file the forms. And I would say the majority of small business owners out there who historically have been required to file these forms have not been filing them. And the IRS is saying now it's time to start filing them, and we're going to make it really stand out by on the form asking you the question, are you required to file, yes or no? And we as tax preparers this tax season, for the first time, we're in a dilemma with clients who we may have told in the past that you're required to file these forms, and they say, I'm not going to do it, and we go, okay, and prepare their return. Now we have a conversation with our client, well, I think you need to file the form, are you going to do it? And the client says, no, I don't want to do it. So then you say, well, if you say no, I have to say, yes, you're required to, but no, you're not doing it. And how is the IRS going to take that information? Is that going to trigger an audit? I don't know. It's too early to say, but I would think at the very least it's going to trigger a letter coming to you in the not too distant future as their systems get in line and they start absorbing all of this information. I think that letters are going to start to go out. I don't know what the letters are going to look like yet. I haven't seen one, but I bet they'll be coming. So we left off before the break with a brief introduction to this new pair of lines on Schedule C that have to do with 1099s. And if there was anything I spent a great deal of time explaining to my clients this year was, yes, you have to do 1099s, and if you are telling me that you're not going to do it, I'm going to have to check no. That's probably not desirable. You don't want me to check, yes, you have to file, but no, you didn't. So are you going to get them out? So there was a lot of April sitting there filling out 1099 miscellaneouses for her clients this year, a lot of that. And a few people taking forms from me, going home and doing it themselves. But either way, that was a conversation I had with every single client that I felt was required to file it. And that was part of what I felt my due diligence duty was as a tax preparer, was to be identifying on the tax return as I was preparing it whether or not I thought a 1099 was required. So in order for any preparer to know whether a 1099 should be issued, we need to understand the requirements, the filing requirements for the form itself. So we're going to spend some time talking about that now. And if you are engaged in a business activity, you are required to issue Form 1099 miscellaneous to each person or business to whom you made the following types of payments during the year. Now, for most of what we do, we're talking in the context of non-employee compensation, but there are other kinds of income reported on 1099 miscellaneous. Among those are rents and royalties. So if you paid at least $10 in royalties or broker payments in lieu of dividends or taxable interest, that triggers a requirement for the form. Or if you paid at least $600 in rent, services including parts and materials, prizes and awards, other income payments, medical and healthcare payments, crop insurance proceeds, cash payments for fish or other aquatic life, or generally the cash paid from a notional principal contract to an individual partnership or estate, that $600 limit is what we're looking at in the year. So if you have a client that you can see they're claiming an expense on the contract labor line of $1,000, well, that's more than $600. Does it mean that they're required to issue 1099s? Possibly. We have to determine, is it 1,000 to a single individual, or was it 500 to 2 individuals each, or was it 300 to 2 individuals and 400 to a fourth or a third individual? Those are the questions that we have to ask. So when I see a number or an expense being given me in a particular category that is greater than 600, the first thing I'm asking is, was that to a single individual or to more than one individual? And if it was to more than one, how much are we talking? Also, if you paid any amount at all for fishing boat proceeds or gross proceeds of $600 or more paid to an attorney, those trigger requirements for the forms. Now, expenses that may require 1099 reporting, or the types of expenses that you should be looking for on the return that would probably trigger the requirement, are commissions and fees, contract labor, legal and professional fees, rent or lease. And that rent or lease one, my gosh, you know when I learned about that? Probably 1994, 1995, I sat in my first real-life audit. A client of mine that owned the coffee shop was getting audited. And one of the things the auditor said was, you're paying rent on the coffee shop, how come you didn't 1099 your landlord? Well, we didn't know we were supposed to 1099 the landlord. Well, yeah, you're supposed to 1099 the landlord. And we moved on. They didn't fine her. They didn't get mad at her. They just kind of said, oh, by the way, you should be doing this. So that's how long ago I knew about that rule, talking 1995. So it's not a new one. It's an old one, been around a long time, but it's something that we don't think about. You paid rent. Who did you pay rent to? Because rent in a year is going to go over 600 pretty easy, isn't it? So rent is something that does need to get 1099. Yes? We'll get there. So if you made payments in 2011 that require you to file any 1099s, you need to check the yes box. If you can see that the amounts showing for expense categories are under the threshold amounts, then you typically don't have to file the form. Does the form have a filing deadline? As a matter of fact, it does. And it is possible to get an extension to file. It's only a 30-day extension, hardly worth the effort if you ask me. But you can file for an extension using Form 8809. Now, we're going to go into a few of the additional rules you need to know about issuing 1099s, as well as some exceptions. Who do you not need to issue a 1099 to? Firstly, trade or business reporting only. You should issue a Form 1099 miscellaneous only when you made payments in the course of your trade or business. Personal payments are not reportable. So what that means is if you rent your home from your landlord, that's not a business expense that you're paying out. You don't 1099 the landlord of the home you're renting. But if you run a business and you're paying rent to a landlord for your business, then you would need to 1099 that landlord. There is some exceptions to the 1099 requirement. Some payments are not required to be reported on Form 1099 miscellaneous, although they may be subject to tax for the recipient. Payments for which a Form 1099 is not required include payments made to corporations, except in the following situations. If the corporation is medical and healthcare payments that reported in Box 6, it still needs to be 1099. Fish purchases for cash reported in Box 7. Attorney fees reported in Box 7. Gross proceeds paid to an attorney reported in Box 14. Substitute payments in lieu of dividends or tax-exempt interest in Box 8, and payments by a federal executive agency for services or vendors reported in Box 7. So in general, if you are making payments to a corporation, even if you paid that corporation more than $600 during the year, you don't need to 1099 the corporation. However, if the corporation is an attorney or involved in fishing, you still need to 1099 them. I have a caution here. An entity is not a corporation simply because it has the word company or co in its name, unless the company is an insurance company. An entity that states it is incorporated, however, or uses the word incorporated or Inc. in its name generally can be accepted as being a corporation. Now here's the deal. Lots of small business owners go out and form these limited liability companies, and they think they're incorporated. And so they'll walk in, yeah, I formed a corporation this year. I'm incorporated now because I formed this LLC. Worse yet, I've had clients come in and tell me they're incorporated. They didn't even form an LLC. They didn't even register a business name. They just opened their doors for business and decided that they were incorporated. So I don't ever actually take my clients at face value on that. Now here in Oregon, we have a wonderful online system. It's called filinginoregon.com. And I can go to that and type in the name of my client's business and see what pops up. And whenever I get a new client that is unable to present to me any kind of formal incorporation document, I'm assuming they're probably not incorporated until filinginoregon.com tells me that they are. And all I need to do is go to that website, type a search for their name, and it tells me if they're incorporated. It tells me if their corporation is currently active. It tells me if they, in fact, only have an assumed business name and that they're not incorporated. It tells me if they're an LLC. It basically tells me the type of entity that they're registered under and whether that entity is active or inactive. Now, if the little state of Oregon can pull that off, it wouldn't surprise me if other states out there have something similar. It's just a matter of kind of looking for it. Filinginoregon.com goes through the Secretary of State office here in Oregon, and so I would be looking to your Secretary of State office and seeing what system they have in place for actually researching information like that. I'm sure it's a matter of public record, and it's just a matter of how easy your state has made it to look them up. But whenever I get a new client, I automatically look them up. If they tell me they're a particular entity type, I want to see it for myself, because so often they are not what they call themselves. Also, you are not required to issue a 1099 if you made payments for merchandise, telegrams, telephone freight, storage, and similar items. This is a rather important one because, you know, one of the when you're working with a restaurant, for example, or you're working with a retail store, they're going to be making lots of payments to vendors. And very often those payments are in cash or by check because the vendor will make the delivery and they expect payment at that time. And if they, is there going to be a transaction going on at that time to get a W-9 filled out to figure out their EIN and so forth? Usually that hasn't happened, and I've had my clients who run restaurants just absolutely pitch a fit at the thought of having to 1099 their vendors. But fortunately they don't need to because the nature of the fact is that they're buying product. It's really, the 1099 is intended for services. Also, payments of rent to real estate agents, you don't have to 1099 a real estate agent if you're paying them rent. Obviously, you do not 1099 an employee when you're paying them wages. You're supposed to give them a W-2, but how often do we see employers 1099 employees because they either don't know any better or basically they're cheating, trying to get away with it. And let's move down to something here called nominee reporting requirements. Question? Okay. There's a question is, if I'm paying $600 in rents, I'm supposed to 1099, but if I pay $600 in rents to a real estate agent, I don't have to 1099 them. What's the difference? Well, you can pay rent to someone who's not a real estate agent. So what the rule is saying is if you pay rents to a real estate agent, you don't have to 1099 the real estate agent. Why that is, I don't know. It's just a rule, I'm telling you. But if you're paying rent to anyone who is not a real estate agent and they are also not a corporation, you're going to pass those two tests, then you would need to 1099 them. Nominee reporting requirements. Generally, if you receive a 1099 for amounts that actually belong to another person, you are considered to be a nominee recipient. So what happens is you've received a 1099, and the money being reported on that 1099 is not money that you received. Or if you did receive it, you received it on behalf of someone else, and you've turned it over to them. I actually had a client who did that once. He was a trucker. God. Okay, he was a trucker. The stories I have to tell. Okay, so he's a good old boy, kind of a redneck trucker, done his tax return for many, many years, and he actually tries to do the right thing. He heard that if you get behind on your taxes, they'll take away all your property, and he happens to have property that he never wants to lose. So even though his inclination is to be very casual about most things in life and probably gets lots of speeding tickets, he's never going to fail to file. He files every year. Well, one year I had a baby, and so he ended up working with another tax preparer in our firm, someone who was not as experienced as me. And oh my gosh, a year later he got audited, and the reason he got audited was because he had a buddy who had lost his his permission to own a trucking business. He could still drive, but he couldn't run his own outfit anymore. So my client said, oh, you can drive for me. But he was really in his own business, and basically the money was running through my client to this other guy. So, so he never told us that he even had the money. It didn't get reported on his tax return. He didn't think of it as his money. It had gone through. And I don't know if it came up in the conversation with the preparer in my office who did his return for me that year, but at any rate, it happened. And he got audited on it. And so we're sitting at the desk with the auditor and explaining what happened. Yes, the money apparently should have been entered on the return, but then there should have been this expense entered as well. They all balanced each other out. And in the end, we were able to convince the auditor of that. But the whole point was the correct formality behind it is that my client was issued a 1099 for that income. The income was not his. So what he should have done at that point is 1099'd out again to the other trucker. And that was the step that had not happened. So it's important to take that action. All right, so when you are required to file a 1099, how do you do it, or when do you do it? You need to file the 1099 by February 8, 2012 if you are filing it by paper, or April 2, 2012 if you are filing electronically. And if you can't file it by those dates, you can file for a 30-day extension, which gives you an extra month, which, as I say, isn't very much. What happens if you're required to file a 1099 and you don't? Well, there are some penalties in place. Now, I have to say, in all the years I've ever done tax returns, all the clients I've ever had required to file 1099s who haven't, which is pretty much nearly all of them, I've never seen anyone assessed any of these penalties. I think the potential is there, but the IRS has essentially not been enforcing the 1099 issue, and it's not been enforcing the penalties, but I think things are going to start changing. So the first rule is that it's a $30 penalty per 1099 not issued if you file within 30 days of the due date, but you file late. It goes to $60 if you file correctly, but more than 30 days after the due date. And it's $100 if you file after August 1st or you fail to file at all. The interesting thing is it's a $100 failure to file the form penalty at that point to the IRS for failure to file with the IRS. But if you haven't filed with the IRS, it probably means you haven't filed with the recipient either, haven't issued to the recipient. And all these same penalties apply for failure to issue to the recipient. So really, each of these penalties is double what it says. There are some exceptions to the penalty, none of which are very forgiving. You may qualify for reduced penalty in the following situations. The penalty will not apply to any failure that you can show was due to reasonable cause and not willful neglect. Now, I suppose if you could say, I had no clue I was supposed to issue a 1099, I just didn't know anything about it, sometimes that excuse will fly once. Once you've had your warning, it will never work again. IRS says also if the failure is due to an inconsequential error or omission, you're probably going to be okay. However, errors and omissions that the IRS says are never inconsequential are those that relate to the taxpayer identification number reported on the form, the last name of the payee shown on the form, or any money amount that should have been reported on the form. In other words, those three things need to be correct, even if you had the address wrong or other information wrong. Those three things have to be correct. There's also this de minimis rule for corrections. Even though you cannot show reasonable cause, the penalty for failure to file correct information returns will not apply to a certain number of returns if you filed those returns, either failed to include all the information required on a return or included incorrect information and filed the corrections by August 1st. So I don't actually consider any of that to be terribly lenient. They seem to have the ability to impose pretty harsh penalties. It's just been my experience to this point in time that they're not doing it, but something tells me the writing's on the wall that things are about to change. All right, so you have to issue a 1099 to someone. How do you get the information to do so? And the IRS has a form for that called Form W-9. When you are a small business owner, you may have businesses give you this form and ask you to fill it out to give to them. And in turn, you should be giving this form to people you do business with or make payments to, so that you can issue them a 1099. Now, I get several phone calls a year from clients who say, yeah, I was just handed this W-9 and I'm told to fill it out. Do I have to do this? I don't want to do it. I don't like giving them this personal information. And my answer is, yes, you do have to fill it out. And if you don't want to give them your personal Social Security number on it, then that would be a reason to apply for an employer identification number so that you can put that number on instead. Now, for my clients, one of the things I like to have them do is anytime I see them making payments of $600 or more to any entity, I have them get that entity to complete the form. Because even if the entity is a corporation, now they have proof that the reason they didn't 1099 was because the entity said that they were incorporated. I mean, we can go to the internet and try and determine whether the entity they made payments to is incorporated, just for example, by going to filinginoregon.com and seeing if they're listed there as incorporated. That's one way of answering the question and then maintaining a record of that. But the other way is simply to ask the entity to fill out the form. And then they can check what kind of entity they are. And if they check C corporation or S corporation, then they wouldn't need to be 1099. But if they check individual, sole proprietor, partnership, trust or state, limited liability company, then they would need to be 1099s. Now, okay, you've issued the 1099. You think you've been very good, very well behaved. You've done everything you're supposed to. And a few months later, the IRS sends you this letter called a CP-2100A or a CP-2100 notice. And you open the letter, and the IRS says, you issued 1099s that were in error. We've got mismatches between the name and the identification number of the payee listed on the 1099. You need to mail them a B notice. Now, have any of you had calls from your client in the last year saying, yeah, I got this letter from the IRS that tells me I need to mail out a B notice? What's a B notice? We're going to talk about that. It just all of a sudden, boom, out of the blue, started on me about midway through last year. And probably July or August is when my clients started calling me saying they were getting these letters from the IRS telling them they needed to send out B notices. What's that? And I went, I haven't a clue, but I'll find out. And then the IRS actually at its update forum last November started talking about the B notices there. So this is the new thing that they're onto. If you are a payer who is required to file Form 1099 documents, you must provide the correct taxpayer identification number and name of the payee. If the payer submits a 1099 document with a missing or incorrect, that is mismatched TIN, the IRS will send you, the payer, a CP 2000 or 2100A letter or a CP 2100 notice to notify the payer that he or she may be responsible for backup withholding. The notice is accompanied by a listing of the missing, incorrect, and not currently issued payee TINs. Now, if you're a small business, you're probably just going to get a CP 2100A notice. Mid-sized filers, that is people who have filed 51 to 250 documents that have errors on them or more, well actually in that range there, will receive a CP 2100 notice. And large volume filers who have filed 250 or more documents with errors are going to receive a CD. These are all the people that are wrong, and all of these people that you have wrong numbers on, you need to start backup withholding is essentially what the letter says. So what should you do if you get a CP 2100 or 2100A notice? Well, the notice will state which names and or numbers are either a mismatch or missing. You compare the names and numbers listed with the notice in your records. If you are missing a TIN and you have not yet started backup withholding, you are required to do so immediately. So you got the letter from the IRS, it says the TIN is missing, you need to start backup withholding. Now that's assuming you're still making payments to the individual, right? If you only paid them one time and they're gone from history, it's going to be difficult to start backup withholding on them. In addition to starting backup withholding, you need to send them a letter. This letter is called an initial solicitation. You must make the initial solicitation when the payee opens the account. Well, the initial solicitation would be, okay, we're going to do business together. I'm hiring you to perform this service for me, and here's the W-9. Now, of course, if you fail to give them the W-9 when you first decide to do business with them, another opportunity to ask for the W-9 to be completed would be about the time you're trying to pay them. Oh, I need to pay so-and-so. Would you please fill out this W-9? And then the individual says, I don't want to do that. And you say, well, I guess I have to back up withhold 28%. So the deal is at the time you engage in the business transaction is the time where you should be getting the information. But obviously, most small business owners don't think of that. It doesn't cross their mind that they're supposed to have a W-9 filled out at the initial opening of that engagement. Now, these days when you go to a bank account or go to open up an account in a bank or you open up a brokerage account, you will be given the same W-9 form by that brokerage account and asked to provide that information. And if you fail to do it, then they'll start backup withholding on you. So I do have clients these days who are showing backup withholding on their savings accounts, and they're asking me, why do I have backup withholding? And I'm saying, well, apparently they asked you to fill out a W-9 and you didn't do it. So to make it stop, you need to fill out the W-9 form. So the initial solicitation should happen at the time the account is open. But let's say you didn't do that. You file a W-9, or not a W-9, but you file a 1099 with an incorrect or missing number. So the IRS sends you the CP 2100 notice and says time to send out a solicitation. The first notice you mail out is called the first annual solicitation. If the payee does not provide a TIN after initial solicitation, you have to make a first annual solicitation by December 31st of the year in which the account is opened for accounts opened before December, or January 31 of the following year for accounts opened during the preceding December. You then are supposed to send a second annual solicitation if there is no response to the first one. If the payee does not provide a TIN after the first annual solicitation, you will need to make a second annual solicitation by December 31 of the year following the calendar year in which the account was opened. So your client opens an account in 2001, you make payment with them. And when the IRS says opens an account, they mean really they started transacting business with you and you are paying them money for their services. And they're not a corporation, so you're supposed to be 1099ing them. At that initial point, you asked for their EIN or their Social Security number, and you didn't get it. December came, you asked for it again, they didn't give it to you. So you know your tax preparer is telling you, oh, I've got to file a 1099, and the person's not giving me the information, I'm just going to send a 1099 with what I have, but it doesn't include a number, so it's blank. And at that point, the IRS is going to send out the CP 2100 notice saying, hey, it's time to send another solicitation. And that another solicitation would have to take place by the end of 2012. Because the payment went out in 11, the next solicitation has to go out by the end of 2012. So first and second annual solicitation requirements. A solicitation is a request for a payee's correct TIN. You must make the request to satisfy the backup withholding requirements and to avoid a penalty for filing another information return with a missing or incorrect TIN. For a 1099 miscellaneous and a 1099-K payment, the payee may furnish or provide the TIN in any manner. With respect to payments of interest, dividends, and amounts subject to broker withholding, the payee must furnish a certified TIN on a Form W-9. So your client is not required, or not your client, if you are making payments to a service provider who is, and you're not in the banking business or in the brokerage account business, you don't have to have them fill out the W-9. You can get the information over the phone. The W-9 is just a mechanism for collecting the information, but these brokerage accounts, banks, they are required to have all the account holders fill out W-9s. But from the small business owner's perspective, isn't it enough to pick up the phone and call this vendor that I did business with and ask them for their number over the phone? Can I work with that? The answer is yes. For incorrect TINs, you must make up to 2 annual solicitations called B notices to a payee in response to the 2100 notices. You must begin to back up withhold on all reportable payments to the payee 30 business days after you receive the CP 2100 notice. You must stop backup withholding on payments within 30 calendar days after you receive the required certification, Form W-9, from the payee, or TIN validation from the Social Security Administration or the IRS if it was a second notification. At your option, you may start and stop backup withholding at any time during these 30-day periods. So what that's saying is IRS has sent you a CP 2100 notice and says the tax document you filed, the W-9 you filed, either has a missing TIN or an invalid mismatched TIN. And at this point, you look at your service provider and you say, am I still doing business with this person? Because if I am and I owe them money, I am at that point required to start backup withholding on that day until I get the information. Now, if I call them up that day and I get the information over the phone, do I still have to do the backup withholding? Well, IRS is technically saying if they certify it on a W-9, no, you don't have to start the backup withholding. But if they just give it to you over the phone, then you would have to verify it with the Social Security Administration. You can do that through a website. So there has to be some kind of certification in place so that you can verify that the number is actually a valid, good number. Now, I have a firsthand experience with this whole process here. We had a new landlord, and we wanted to 1099 him because we saw we had this requirement, and it wasn't going to be something that we could just, don't worry about it, even though you know you're supposed to do it, just ignore it because no one cares. Well, now we have to say on the form that we issued them the 1099. So new landlord, we tell him that we need to give him a 1099 and I need his EIN or his social security number. And he says, no. So I said, well, I'm sorry, you are required to give it to me, and if you don't give it to me, I'm going to start backup withholding. And he says, if you start backup withholding on me, I'm going to cancel your lease. And I said, you can't do that. So we had quite a fight, me and my landlord, this past tax season over this EIN and the 1099 miscellaneous. Needless to say, I won, because ultimately I am in the power position. I have the law on my side, and I am in control of the money that he's not getting. So that's the thing. When you are the person making payment, the point at which you can always hold out is saying, I'm going to hold the 28% if you don't give me this information. And if they're saying I refuse to give it to you, then you are required under the law to do that backup withholding. Now here's the deal with the way backup withholding requirements work. If the IRS has ordered you to do backup withholding and you don't do it, what happens? Yeah, they'll basically say that you were supposed to do it in trust for them, and because you failed to do it in trust for them, they're going to make you pay it anyway. So if you don't withhold it from the person that you're, or the party that you're supposed to withhold it from, then the IRS will make you pay it as if you had. It's 28% of the payment. So if the payment is supposed to be $1,000, you're supposed to hold out $280. Time allowed to send B notices. You must send the first B notice and a Form W-9 to the payee within 15 business days after you receive a CP 2100 notice. If you receive a proposed penalty notice but not a CP 2100 notice, your annual solicitation must be made by December 31 of the year you receive the proposed penalty notice. So what goes out in a B notice? What is a B notice? Well, the first B notice. If this is the first CP 2100 notice you have received with respect to this account, that is the payee, you must provide the payee with the first B notice and a copy of Form W-9 or an acceptable substitute. You must also or may also provide an optional reply envelope. Your outside mailing envelope, that is the envelope you use to mail the B notice in, must be clearly marked Important Tax Information Enclosed or Important Tax Return Document Enclosed. The second B notice, if you receive a second CP 2100 notice for a payee within a 3 calendar year period, you must issue a second B notice. Do not include a Form W-9. The second B notice tells the payee to contact IRS or Social Security to obtain the correct name TIN combination. You may also provide an optional reply envelope. The envelope you mail the B notice in should be marked clearly Important Tax Information Enclosed. If a B notice is returned to you as undeliverable, you must begin backup withholding immediately. You should try to get the correct address for the payee and remail the notice. If you cannot find the correct address, keep the undelivered notice with your records for a period of 3 years in order to track the 2- and 3-year rule or until you have obtained a valid address. When should a business use Form W-9? Well, the W-9 is used to make the initial solicitation. And for federal tax purposes, it should be issued to any U.S. person, and a U.S. person includes any individual who is a U.S. citizen or resident, also a partnership, corporation, company, or association created or organized in the United States, any estate other than a foreign estate or a domestic trust. If you're doing business with foreign persons, you have them fill out a different form, and that form is called a W-8. W-8 has there's a whole bunch of W-8s out there. So if you're dealing with a foreign individual, you'd need to go and read up on IRS's website about Form W-8, and they have a whole publication on it called 515. Penalties. The penalties apply for failure to provide a TIN when requested. So you've requested someone to give you their TIN and they are refusing. Is there a penalty for that? Yes, there is. It's $50 for each such failure. Not a very big penalty, but it is there. Also, false information with respect to withholding. If you make a false statement with no reasonable basis that results in no backup withholding occurring, you are also subject to a $500 penalty. Falsifying information. Willfully falsifying certifications or affirmations may subject you to criminal penalties, including fines and/or imprisonment. And finally, misuse of TINs. If the requester discloses or uses TINs in violation of federal law, the requester may be subject to civil and criminal penalties. And here's the provisions on backup withholding. Entities required to report payments made on Form 1099 or W-2 must perform backup withholding if the payee fails to furnish a correct TIN. Section 3406A1 requires certain payers to perform backup withholding by deducting and withholding income tax from a reportable payment if the payee fails to furnish the payee's taxpayer identification number to the payer on a required return, or the IRS notifies the payer that the TIN furnished by the payee is incorrect. All of the following types of payments are subject to backup withholding. They include interest, dividends, patronage dividends, rents, profits, or other gains, commission fees or other payments for work you do as an independent contractor, royalty payments, and certain other payments. Withholding rules. When you open a new account, that is, begin engaging in business with someone, make an investment, or begin to receive payments reported on Form 1099, the bank or other business will give you a Form W-9, and you need to fill it out for them. The payer must withhold at a flat rate of 28% in the following situations. You do not give the payer your TIN in the required manner. The IRS notifies the payer that the TIN you gave them is incorrect. You are required but fail to certify that you are not subject to backup withholding, or the IRS notifies the payer to start withholding on interest or dividends because you have underreported interest or dividends on your income tax return. The IRS will do this only after it has mailed you 4 notices over at least a 210-day period. How to prevent or stop backup withholding. If you have been notified by a payer that the TIN you gave is incorrect, you usually can prevent backup withholding from starting or stop backup withholding once it has begun by giving the payer your correct name and TIN. You must certify that the TIN you gave is incorrect. If you have been notified that you underreported interest or dividends, you must request and receive determination from the IRS to prevent backup withholding from starting or stopping backup withholding once it has begun. We actually had a client that happened to. IRS started doing backup withholding, or she had a bank account or a brokerage account of some kind, and she was not reporting correctly. And so they started backup withholding, and it took almost a year to stop it because the IRS had to give that particular company permission to stop. Verification of TINs. It is possible for a business to verify the correctness of a payee's TIN through the Taxpayer Identification TIN Matching Program. By using the program, a business can verify a TIN and thereby avoid possibility of filing a reporting document with incorrect information. So there are procedures here you can look up if you want to learn how to do that. IRS matching process. Businesses that are required to file Form 1099 or W-2 must include a correct name or TIN combination that allows the IRS to match information on the return. And we've been dealing with this at the 1040 level for a long, long time, because whenever we transmit a tax return electronically to the IRS matches the first 4 letters of that client's last name with the Social Security number on record for that client. It does it for the client, and it also does it for every dependent on the return, and it also does for the spouse on the return. So for many, many years now, we should, if we've been in business a long time and we have been e-filing, have experience with tax returns being rejected because of these mismatches. Well, it's that same kind of process that is going on when the 1099 is issued, that there is a matching process going on there. And so what I've got for you coming up next in the manual is some information on the name control systems that the IRS uses to do a match. Now, when we're doing a tax return in a computer, the computer asks us to put the first name and the middle name in one field and asks for the last name in another field. And the reason it does that is that the IRS is going to look to that particular field to match the last name. So if the client has a name of Ralph Teek, you would put Ralph in the first name field, Teek in the second name field, and then Teek will match up with that Social Security number. So they're looking to see that 4-character name match up. If the last name is Willow, it's only going to look at the first 4 letters. If it's McCedar, it's going to still look only at the first 4 letters. There is some confusion that comes into play when we're dealing with hyphenated names. And in a hyphenated name, IRS is going to look at the first 4 letters of the first name in the hyphenated name. If it's looking at a joint return, it will look at the last name of both filers. We've got Joseph Ash. It will look at Ash, and it will also look at the spouse in Joan Maple. Actually, we've got Joseph Ash and Linda Birch. Who would look at Ash because that's the name of the primary filer, but independently they would also be looking at Linda Birch and looking at B-I-R-C-H. And on a joint name, they're looking at the first 4 letters of the last name on the joint. But either way, on a joint return, they're still looking at the first 4 letters on each. Now, if a payee has changed his or her name at the Social Security Administration, the Social Security Administration will take that name change and forward it to the IRS. Sometimes it's rare these days, but 20 years ago when I first got into this business, it was not that uncommon for us to have clients who had a name on the Social Security card that just wasn't, IRS kept kicking back saying it was invalid when it was valid. And so what we would do in situations like that is have them go back down to Social Security and reapply for another card. And about 10 days, 3 weeks later or so, the Social Security system would update the IRS's. But very often another reason for a problem is a client gets married. They're now married, and the spouse has, the new wife has changed her name on her driver's license. She's starting to call herself by her husband's last name, but she's not taken that step of going down to Social Security and changing her name at Social Security. So the tax returns get filed, and the tax return is rejected because her name is not a match. And the reason it's not a match is she hasn't changed it at Social Security. So the solution is, of course, that she has to go down to Social Security and change it. Now, when you're looking at a tax return for, say, a Schedule C or a sole proprietor, the W-9 form, when you fill it out, not the W-9, the 1099 miscellaneous form and the accompanying cover sheet 1096. When you are a business, it will ask for the name of the proprietor, and it will also ask for the business name. And even though it's asking for both pieces of information, IRS is actually going to be looking at the name of the filer and doing a match on that. It won't be attempting to match the name of the business. That's when you're dealing with a sole proprietor. When you're dealing with estates and corporations, however, it is looking for other fields, and it may, how do we find in the estate, the Frank White estate, what field is the IRS looking for? Is it looking for FRANK, or is it looking for White? And IRS says it's going to be looking for White. Or the estate of Frank White is still looking for White. Trusts and fiduciaries, here we have Jonathan Periwinkle Irrevocable Trust. IRS is saying it's going to look at Perry. Or if it's a church, the Memory Church Endowment Trust. It's going to be looking at the first word in Memory Church. So they seem to have a system in place, but it may not be that simple to figure it out. Then we move over to partnerships. And IRS says if the word the appears in the name, they're going to drop it. And in this case, they went for OAK space tree, first 4 letters. The merry-go-round, they look at Mary, just M-E-R-R. Other types of organizations, they have one here where we're looking at the St. Bernard's Methodist Church building, and they went with ST space BE. That's what they're looking at. So let's take a look at the 1099 miscellaneous itself now. You can be a recipient of a 1099 miscellaneous. You can also be the person who is issuing a 1099 miscellaneous. I do see a question coming up from Majid. It says, what should we do if IRS sends a notice but the name and TIN matches with the W-9? Okay, well, if the name and the TIN match with the W-9 you were issued, you need to contact that payee immediately and say, hey, you've given me a mismatch here. What's wrong? Maybe they wrote it down wrong. Maybe they've changed their name, but haven't changed it with Social Security. Those are the types of reasons why there would be a mismatch, or it could be they just pulled it out of their hat and it's fake. So from the point that if they've given you a W-9 and the name on it is not matching the TIN on it, I would be using that Social Security Administration matching verification system or the IRS's matching verification system to try and get it through. And if it's not going through, it's because there's an error somewhere. Now, earlier this year I had a client. He has an S corporation. The city of Portland was trying to issue him a 1099-G for a refund that the city had issued his business. And the city called me to say that the employer ID number on the return that was filed with them was invalid, that the matching system they were trying to use was saying it was invalid. And I kept saying, no, it's perfectly valid. We electronically filed that return this year, and we electronically filed the return last year with that exact information. So I don't know what your problem is. It could be they were just entering it, typing it in wrong. But IRS is the end game. If IRS says it's a match, it's a match. And if IRS says it's not a match, there's a reason for it. So I would not just ignore the problem. I would definitely research and figure out what's causing it. So looking at the Form 1099 miscellaneous, we have boxes 1 and 2 where rents and royalties are reported. So if you paid rent to a landlord in the ordinary course of your business and your landlord is not a real estate agent and is not a corporation, you would need to issue them a 1099 and you would enter the amount of rent you paid them in that box. Moving on, we have the other income box. Sometimes the other income box reports information that really belongs in box 7. So you have to be on your toes. The income reported in box 3 may or may not be subject to self-employment tax. You're going to have to make a determination on that fact by interviewing your client. Box 4, federal income tax withheld. For most of the history that I've been involved in taxes, that box has always been blank. But based on the conversation we just finished, I can see that we might start to see numbers in that box. If you see a backup withholding amount in the box, you will treat that as withholding on the tax return and enter it as withholding on Form 1040. Then we have the non-employee compensation, and from our standpoint as tax preparers, this is the box that usually has a number in it. And if there's a number in box 7, it means you need to do a Schedule C, unless it's a farmer. And then we move on to the Schedule C, Part 1. We're looking at line 1A to begin with. The merchant card and third-party payments for 2001 enter 0. So 2001 is a transition year. To step up enforcement and to make sure that people are reporting all of the income they are receiving from their businesses, there is a new law in place that is requiring merchant credit card companies and third-party network providers to issue a new document called Form 1099-K. In the case of a credit card company, such as Visa or MasterCard, if you accept payments from your customers via credit card, you will get a 1099-K. There's no minimum amount or baseline amount for getting that 1099-K. The fact that you accepted a single credit card payment during the year means you're going to get a 1099-K. But if the way you do your business is over PayPal, so you're using PayPal over the internet or Google Checkout over the internet, you will only receive a 1099-K in that case if the total amount of payments received through that third-party network provider exceeded $20,000 for the year and the total number of those transactions exceeded 200 for the year. So I think that the initial effort is to step up enforcement really of all those people who are running those online internet businesses with, eBay and so forth. But these are pretty generous thresholds. I can see that people are going to be still getting away with not reporting income for a while until they reduce these thresholds. But in any event, anyone who's running credit cards through their business is going to be getting them. And anyone who's got a fair size eBay business going is going to be getting them as well. This is what the 1099-K looks like. And it breaks down the payments that you receive through your merchant Visa credit card company or through PayPal by month. There's no confidential information that appears anywhere on the form about the accounts that were used to pay you the money. It's simply an income reporting document that shows how much income you made in each month. Payments made with a credit card or a payment card and certain other types of payments, including third-party network transactions, do have to go out on that document, and they did see them starting to trickle in this year. But we can see that the IRS has said that this is a transition year. People are not going to be exactly sure what the documents mean. There's probably going to be some errors. And one of the biggest errors that I can see being out there, and one that the IRS is really aware is probably going to be a big problem in the beginning and probably into the future, is that if you are a business and you accept payments via credit card, or you could also be a business person who you are making payments with a credit card, right? So actually in this context, I'm thinking more of you're making payments. So you have a customer. No, you have a vendor. You have someone you're doing business with. I'm trying to get this straight in my own head. So you're doing business with a person who provides you services. And that person accepts credit cards. So you pay them with a credit card. For example, a plumber. So we needed some plumbing work done on our building, and the plumber came out. Did I pay the plumber with a credit card, or did I pay the plumber with a check? If I paid the plumber with a check, I need to get him to fill out a W-9 to certify himself, and I have to send him a 1099 at the end of the year. If I paid the plumber by a credit card, what then? Who gives the 1099-K? Do I give the 1099-K because I paid with a credit card? No. No. The credit card company is the one that issues the 1099-K. I, as the business owner who purchased stuff with a credit card, I'm not the one that issues a 1099-K. But what's interesting is there could be some confusion. Since I paid with a credit card and the 1099-K is going to be reporting that income, do I need to turn around and issue a 1099 again? And the answer is definitely not. So this is quite a big accounting nightmare, as you can see. Now a small business has to start tracking whether or not it's paying service providers via credit card or Google Checkout or PayPal, or whether it's paying via check. And if the small business, or any business rather, is paying via check to a service provider for which a 1099 should be issued, they need to go ahead and issue that 1099 miscellaneous for non-employee compensation. But if you paid that same provider via credit card, any amount that you paid them during the year via credit card, you would not 1099 on. So it's conceivable you have the plumber come in and the plumber says, yeah, I'm going to need a $500 deposit and I'll come back on Tuesday and start working. So you give the $500 deposit in the form of a check, the plumber comes back, does all the work, and then you use a credit card to pay for the rest of the work. So you would only 1099, well, you wouldn't need to 1099 for a $500 check, would you? But if the check had been $700 and then you'd paid another $2,000 on credit card, you would 1099 for the $700 check. You would not 1099 for the $2,000 on the credit card. So it's complicated, and if you can see, it takes a bit of thinking to sort it all out. You can imagine what it's going to be on the accounting side of things with us as tax preparers saying now, okay, you had this expense for $1,000 on the service provider line. Who did you pay this to? Okay, well, I paid it to Joe's, I don't know, artwork. He does art for internet design or something. So I paid him to provide a service for me doing some design work. Okay, did you pay him with a check or a credit card? That's going to be the next question. And so it is getting complicated. I do see a question coming up here from Majid. If we correct 1099s, what is the amount we put on the 1096? The amount of the corrected one or the whole payment amount for the year? When you send in a 1099, you send a cover sheet called a 1096 with it. And I'm not prepared to give a lecture on what the 1096 instructions are, but when I fill out a 1096, it's asking me how many 1099s are with it and what the amount reported on the 1099s is. So I would say that that's how you fill it out. You've got if you fill out one 1099 and you mail it in with a 1096, the total of the two should match. And if you send in two 1099s with a 1096, the total of the two 1099s should be entered on the 1096. So that would be how I would fill it out. If any of you have any questions for me? Let me see. Also about credit card payments. What's your question, Kishore, also about credit card payments? Oh, you asked me another question on credit card. Let me see. What happens when a store owner is getting money for travelers' Western Union transfer? Through a credit card? Would you go to Western Union and transfer money with a credit card? Yeah. I don't know about that. When you make a payment with a credit card, I think, oh, I know that there's these cash back questions. When I was at the IRS forum, there was a question going on. It actually wasn't a forum, it was a tax practitioner liaison with the outreach people from IRS here in Oregon. There was a question about that, you know, what happens when you have these cash backs on debit cards and so forth, and apparently they've got all that worked out. But the ins and outs of exactly how it all works, I'm not sure. Clearly there's a potential for a lot of duplication and errors, and it's going to be some period of time while it all gets worked out. Hopefully 2011 is the year where they're sorting most of it out, but 2012 is going to be the first filing season where we're actually dealing with real numbers and starting to see what's really going to happen. Okay, so we're back from break, and we were on to line 1B. So 1A is the line where you're supposed to be entering credit card payments that you received. But for 2011, they say leave it blank, and in the case of our tax software, it wouldn't even let you put a number there. Line 1B is therefore where you enter all of the other gross receipts of your business for the most part. And if you receive income in the form of cash check, that is normally where you'd put it in 2012 and future years, and you would separate cash check payments on line 1B from credit card charges on line 1A. But in addition to receiving money in the form of cash, check, or credit card, there are also other ways your business can receive income, one of which is through bartering, and you could also be receiving it from canceled debt, restricted property, gains and losses, promissory notes, lost income payments, and damages. Now, depending on the nature of the income, it may or may not be reportable on line 1B, but certainly bartering is something that should be reported on line 1B as income. And canceled debt, restricted property, there are other ways those kinds of income get reported. But if you've received these types of income, my advice to you is to go to publication 334 to look up more instructions on how to treat it. The following items are not income, according to the IRS. Appreciation in the value of property, construction allowances you receive from your landlord, loans that you take out, and sales tax that you are required to collect and then turn over to a state or local government. They don't want you to report that as income. The next line on the tax return, Schedule C, is line 1C. You use line 1C to report income that you received as a statutory employee. You will know that you are dealing with a statutory employee when you look at the W-2 and the box 13 has statutory employee checked on it. If the statutory employee box is checked on the W-2, you will report the amount showing on the W-2 as wage income on line 1C of Schedule C. You will then report all of the expenses associated with that statutory employee on Schedule C, and when you are finally finished figuring the net profit on Schedule C, you will carry that net profit to the wage line of the tax return. And this, as far as I can recall, is a new line. It's not been on here before. We've always had the instruction to report statutory wages on the Schedule C. I just can't remember that there was a box there for it before. Lines 1D, total gross receipts. Since line 1A is 0 for 2011, IRS says enter either the amount on line 1B or line 1C, but you would never combine line 1B and 1C because statutory employee wages should never be combined with any other form of self-employment. Statutory employee wages and self-employment income belong on separate Schedule Cs. Returns and allowances, you subtract the cost of returns and allowances you made to your customers from gross receipts of your business on this line. Returns and allowances include cash or credit card refunds that you make to customers, rebates and other allowances off the actual sales price. Cost of goods sold, we're going to talk about that later in today's class. You need to figure cost of goods sold on line 42 of page 2. There's a whole section in part 3 where you figure cost of goods sold, and when you arrive at the final number on line 42, you carry it over and enter it on line 4 on the front page of the Schedule C. On line 5, you figure your gross profit. Essentially, your income minus cost of goods sold is your gross profit, and then you start adding back in other forms of income. The type of income IRS wants you to report on line 6 of Schedule C is finance reserve income, scrap sales, bad debts that you recovered, interest such as notes and accounts receivable but not bank account interest, state gasoline or fuel tax refunds you received during the year, credit for biodiesel and renewable diesel fuels claimed on line 8 of Form 8864, credit for alcohol and cellulosic biofuels claimed on line 7 of Form 6478, credit for federal tax paid on fuels claimed on your 2010 Form 1040, prizes and awards related to your trade or business, recapture of accelerated depreciation and Section 179 deduction, and other kinds of miscellaneous business income. Includes amounts you received in your trade or business as shown on Form 1099 PATR as well. Now, of all of those types of other income to report, I'm only going to mention a little bit more about 2 of them. The first one is interest income, and in business, in the ordinary course of operating your business, you can get interest from a variety of sources. And some of those sources are reportable on line 6 and some are not. So how you report your interest depends on the type of interest you are receiving. If you received interest on notes receivable or accounts receivable that you have accepted in the ordinary course of your business, that is reported as income on line 6. So you have a product that you sold and it's now accounts receivable, you're paid late on it, so you're charging interest until it's paid. When you finally do get that payment, you would report it as other income on line 6. Interest received on loans is business income if you are in the business of lending money. So if you're a commercial lender and your business is lending money, then you would report interest received on those loans as income on Schedule C. But if you're not in the business of lending money and you received interest, it would only be taxable as business income if it was interest on receivables. Any other form of interest that you would typically receive, such as interest on bank account holdings, is not reported on the Schedule C at all. You should report this kind of interest on line 8 of Form 1040. Now, if you're talking about S corporation or a partnership, and that partnership has a bank account or that S corporation has a bank account, those organizations also should not be reporting interest income on bank account holdings as income of the business. Those income types get separated out and are separated on the Schedule K1. So when you're looking at a Schedule K1 coming in from a partner in a partnership, if there was interest income for that partnership, it should be reported on a separate line. Now on a Schedule C, there's no separate line for interest. It just doesn't belong on there at all as income unless it's on receivables, and then it would be going on the other income line. The next type of other income we're going to talk about is recapture of depreciation. You may be required to include certain previously deducted depreciation items in your income. One of those is listed property. If you took a deduction under Section 179 or accelerated depreciation on your tax return for listed property, and then on the listed property your business use falls to 50% or less, in a year after the year you place that property in service, you're going to have to recapture some of the depreciation you claimed, and you do so in Part 4 of Form 4797. Now, most of the time when you file Form 4797, it is used to report the sale or disposition of a business asset, and the gain or loss carries to line 14 of the 1040 form as ordinary income, or line 13 as capital gain or loss. Actually, usually capital gain. It'll either be line 13 as capital gain, or it'll be line 14 as ordinary income or ordinary loss. But in the case of recapture of depreciation, because listed property business use fell to 50% or less, or because you claimed a Section 179 deduction on property and then took it out of service before the end of its useful life, in both of those cases, the recapture occurs on 4797 in Part 4, and then the profit carries, or the income from that recapture carries to the Schedule C and gets entered on line 6. So let's look at an example of what I mean by that. In 2010, Max purchased and placed a computer in service in his business at a cost of $2,000. He claimed a Section 179 for the full purchase price on his 2010 Schedule C. Then in 2011, his business use of the computer dropped from 100% down to 40%. So the depreciation he claimed in 2010 was $2,000. The amount that he should have claimed straight line is $200. So the difference that he has to recapture is going to be $1,800. And he will enter that on line 6 as other income. So how would his 4797 look? Well, 4797 is a 2-page form, and I've just chopped the very bottom of page 2 off and showing you Part 4 filled out. And you can see here we've got the Section 179 deduction that he did claim, the recomputed depreciation that he should have claimed, and the excess or recapture amount. And this $1,800 would get entered on line 6 of Schedule C as income. Now we're going to move on to lines 5 and 6. That's where we add up our other income and our total income from the business. So we have our final gross income amount. And now it's time to start talking about expenses. And expenses are claimed in Part 2. There are lines 8 through 27 where we enter expenses, and we're going to take each of these in turn, beginning with advertising. On this line, you will enter the cost of advertising your business, such as Yellow Page, radio, or television ads. Also, direct mail and other promotional costs of your business are entered here. Technically speaking, I think you could put internet costs on here, you know, your website advertising. Website, I think that's a good place for it, but you might separate website out and just stick it on the other expense line. Then we move on to car and truck expenses. There's more to say about this line for sure. You can deduct the actual cost of expenses for operating your car or truck, or you can claim a standard mileage allowance. This is true even if you use your vehicle for hire, such as a taxi cab. Prior to 2011, you were not allowed to claim the standard mileage rate for taxi cabs, but there is a new provision that now allows the standard mileage rate to be used by taxis. You must use actual expenses, however, if you used 5 or more vehicles simultaneously in your business. If you are operating 5 or more vehicles in your business at the same time, you are considered to have a fleet. And when you operate a fleet, you are required to use actual expenses. You can take the standard mileage rate for 2011 only if you owned the vehicle and used the standard mileage rate for the first year you placed the vehicle in service, or you leased the vehicle and are using the standard mileage rate for the entire lease period. The leased vehicle rule basically means when you have a leased vehicle, you claim actual or you claim standard. You're never allowed to switch between the two. If you start actual on a leased vehicle, you stay there. If you start standard mileage on a leased vehicle, you stay there. You can't flip back and forth. When you're looking at a vehicle that you actually own, you can start off using the standard mileage rate, and if you choose to at a later time, you can switch to actual expenses. But once you've switched to actual expenses on a vehicle you own, you're not allowed to go back to standard mileage rate in any year after a year you claim depreciation. Automobile expense reporting requirements. If you claim any car or truck expenses, you must provide information by completing one of the following: either Part 4 of Schedule C or Part 5 of Form 4562. So in other words, you should never make an entry for an expense on the Schedule C on line 9 right here, this line here. If you enter a car and truck expense on this line, you'd better do something. You either fill out Part 4 of Schedule C or you attach Form 4562 with Part 5 completed. It's mandatory that you do one of those two things. Now we've talked about the mandatory reporting, let's talk a little bit about the types of expenses you can claim, starting with local transportation expenses. Now, earlier in our series, we had a class where we were talking about employee business expense deductions, and a lot of the content that I'm getting into here is similar to what we talked about in that session, and it's because these are simply two different places where the same type of expense can be claimed, and in general, the rules for claiming the expense that we're talking about on Schedule C are the same as they are when you're talking about an employee who's claiming employee business expenses, or for that matter, if you're filing a Schedule E and you were claiming auto expenses related to your rental activities. The rules for auto expense are virtually always the same. Starting with local transportation expenses. Local transportation is never deductible. However, certain local transportation costs can be deductible if they are not part of commute. So local transportation expenses are not travel. They are typically not deductible if they are going to be commute. So the only time local transportation is deductible is when you can show that it is ordinary and necessary part of operating your business. And we look at those types of ordinary necessary costs, including getting from one workplace to another in the course of your business or profession when you are traveling within your tax home, when you are visiting clients or customers, when you are going to a business meeting away from your regular workplace, or getting from your home to a temporary workplace when you have one or more regular places of work. These temporary workplaces can be either within your area of your tax home or outside of it. There is a caution right here that local business transportation does not include expenses you have while traveling away from home on business overnight. So IRS essentially defines auto transportation or travel by car or auto that you own into two categories. One of them is local, and the other is traveling away from home overnight. And the rules for each are different. Actually, even when you're not traveling away from home overnight, when you're traveling outside your metropolitan area. So the IRS essentially says there's local transportation costs, and then there's transportation costs away from your tax home. And it divides those, and the rules for claiming expenses are different depending on what category you're in. So firstly, when you're claiming transportation expenses locally, and it in fact happens to be the case when you're traveling outside of your metropolitan area as well, you have to show that you're going to a temporary work location, or you have to show that you're traveling from one work location to another. So when we're looking at temporary, what does that mean? IRS says temporary means 1 year or less. When we get into long-term or short-term in the world of stock sales or the world of selling assets and whether or not we get capital gain treatment and the long-term capital gain rates, we've got that same concept of more than a year or less. So IRS is pretty consistent in that respect. They consider it to be long-term when it's more than a year and short-term when it's a year or less. And when we're looking at the definition of temporary, IRS says you're temporary if the assignment is expected to last a year or less. So it can be exactly a year, but if it goes over a year, then it is no longer temporary. So if you are assigned to a temporary work location in the same area as your tax home, you may be allowed to deduct transportation expenses subject to the following. Number one, if you have a regular job location and you commute to a temporary work location in the same trade or business, you can deduct the expenses of the daily round trip between your home and that temporary location. But if you have no regular workplace, but you ordinarily work in the metropolitan area where you live, you can deduct daily transportation costs between your home and a temporary work site only if that work site is outside of the metropolitan area. The best example we can give of the differences there, we can look to ourselves in our business of doing taxes and accounting. We get up in the morning, we have an office, we drive to that office, we know where our office is, and we work there regularly, right? Presumably inside our metropolitan area. Let's compare that to, say, a construction worker or a painting contractor who never works at the same place for very long. So if you, for example, you run a painting business and you have, well, even a painting business, you're going to have the place that you normally go to work. It really boils down mostly to the employees who get up in the morning and are told where to go. And they might work at one site for a few weeks and another site at another few weeks, but there's no permanent site that they normally work from. If you're a business owner and you have your own business, you're probably going to get up in the morning and go there, right? So you're still going to have a fixed location. So this concept of no permanent fixed work location really is for people that they don't have a regular place. And an example would be a painting employee of a business. So for that employee is never going to be able to say that they have local transportation costs of going from home to a temporary site inside their metropolitan area. They're never going to be allowed to claim that because they can't show they have a permanent place. And IRS says when you do go from home to your regular job, that's commute, is never deductible. And IRS says if you cannot show that you have a regular workplace and you're driving from home to whatever place you happen to be working for that day, that also is commute and is non-deductible. And IRS says the following is commute. Driving to a temporary job site when you do not have a regular work location. If you do not have a regular job location, you cannot deduct daily transportation costs between your home and a temporary work site within the metropolitan area. These are always non-deductible commute costs. Driving from home to a second job, you also cannot deduct the cost of driving from home to a second job. But if you have two places of work, the following rules apply. If you work at 2 or more places in the same day, you can deduct the expenses of getting from one workplace to the other. But if, for personal reasons, you cannot go directly from one work location to the next, such as a detour to visit your doctor on the way to your second job, you can only claim expenses equivalent to what it would have cost you to travel directly from one work location to the next. So we're talking about Schedule C here, and we're getting a lot of information that is more geared towards the employee. But I kind of don't agree with the thought that it's only directed at employees. It's most absolutely directed at a small business owner, because a small business owner is typically going to have transportation costs. So the question we're asking our client when we're working on their sole proprietor business, all right, you have mileage. Are you working from a home office? Is that the place you do the most of your work? And if you are working from a home office, then do you have a log that's showing when you left your home office going to these other places for business? And what were these other places? Why were you going to them? If they don't work from their home, or even if they do work from their home but they have another fixed work location, then obviously the drive from home to that fixed work location is going to be non-deductible commute. Now if they work from their home and they're a painting contractor, because it's kind of the ones I started to talk about a bit ago, and they keep their paint in their garage and they run their business from their house, when they leave their house and they grab their ladder in their truck and their paint cans and they head off to a work location, they are technically leaving their main fixed work location to go to a temporary location. They will be able to claim that mileage. So the type of people who don't get that local transportation are the people who don't have an office at home, don't have an office anywhere else either, and are just working around the place. So most painting contractors who operate their own businesses are going to have a fixed work location somewhere, whether it's their home or a paint store that they maintain. So what are transportation expenses that are deductible? Well, we have a picture here. This is out of IRS Publication 17, page 183. IRS shows a picture of your house. It says when you drive from home to a regular or main job, that cost is never deductible. If you drive from home to a secondary job, that also is never deductible. If you drive from your home to a temporary work location and you have a regular job at another location, then the drive from home to that temporary job is deductible. If you drive from your regular or main job to a temporary location, that is deductible. If you drive from your regular or main job to a regular second job, that also is deductible. And if you drive from a second job to a temporary job, that is deductible. The types of deductible transportation for local transportation that you might be able to deduct, and also over in this column we have things that you are not allowed to deduct. Deductible transportation includes commuting from one job to another job on the same day. Fees for parking while attending a meeting away from your normal work location. You can claim the cost of putting an ad on your car. You can claim the cost of operating a for-profit carpool which you operate as a business, and you are also allowed to claim added costs you pay because you haul tools or instruments to work. Non-deductible costs. You are not allowed to claim the cost of commuting to and from your job. You are not allowed to claim costs for fees for parking while you are at work. You are also not allowed to claim costs of using your car to drive to and from work or anywhere else just because you have an advertising display on the side. So the fact that you put a sign advertising your business on the side of the car does not make the car business use. You're allowed to claim the cost of the sign because it is advertising, but the business use of the car still has to be tracked separately. You cannot claim the cost of your share of carpool expenses that you pay to travel to and from work. The fact that you haul tools or instruments to and from work does not mean that you are using your car for business purposes. And union member trips to a union hall are not deductible. Now parking is something my clients just hammer at me all the time. Whenever they pay for it, they wanted to deduct it. And you have to be able to show that the parking was not commute. There was a business purpose to it that had nothing to do with commute. And when you get up in the morning and you drive downtown and you pay to park at the parkade downtown so that you can then go to work, that's commute. Or if you pay to park in the lot on the corner downtown so that you can then go to work, that's commute. And commute expenses are never deductible. It doesn't matter whether you are a sole proprietor and you're paying it because that's you operate your business downtown and you have to pay to park your car downtown. It's not deductible. You can't claim it. Now, an employer is allowed to provide free parking for employees up to a certain dollar limit. So if an employer is paying for an employee to be able to park downtown, the employer can do so. And it's considered to be a tax-free benefit to that employee up to a certain dollar amount. I'm trying to think of what it is, 100 and something a month. But the business owner is never allowed to give themselves that benefit. So when can you claim parking? You can claim parking when you pay to visit a customer or a client, or when you were attending a meeting away from your normal work location. Allowable car expenses. If you use your car for business, you can claim the actual cost of operating your car or the standard mileage allowance. If you are claiming either method, you still have to keep accurate records to prove your business use. The records are mandatory. They're not optional. Whether you claim actual or standard, you have to have records. If you're claiming standard, for 2011, the standard mileage rate is 51 cents for the first half of the year, 55.5 cents per mile for each mile driven after June 30th. The following rules apply if you want to use the standard mileage rate. When you use the standard mileage rate, you are using it instead of depreciation, gas, insurance, lease payments, licenses, oil changes, registration fees, repairs, and tires. You claim standard mileage rate or these, but never standard mileage rate plus some of the others. But you still can, in addition to the standard mileage rate, claim parking and tolls because those don't have anything to do with the operation of the vehicle. You must choose the standard mileage rate the first year you use your car for business in most cases. The technical wording of it is, IRS says you cannot use the standard mileage rate in any year after you claimed actual expenses and a deduction for depreciation. But since we learned in our earlier class depreciation is technically mandatory, it means that you would have claimed actual expenses but not depreciation. If that was the case, you can switch to standard mileage, but of course, if anyone knew what they were doing, they would have claimed depreciation. If you claimed actual expenses on a car that you lease rather than own, you cannot claim the standard mileage allowance in a later year. If you claim the standard mileage allowance on a car that you lease rather than own, you cannot claim actual expenses in a later year. But this rule does not apply to a car that you own. If you choose the standard rate, you cannot claim actual costs for operating your car in the same year. Well, duh. Let's do both. I'm going to claim actual costs of operating my car plus the standard mileage rate all at the same time. That sounds like a good deal. I'm sure there are people who try that. Even if you claim the standard mileage rate, you can still claim allowable costs for parking and tolls. You cannot claim the standard mileage rate if any of the following is true. You operate 5 or more cars at the same time for your business. You claimed a depreciation deduction for your car in an earlier year. You claimed a Section 179 deduction for the car in an earlier year. You are a rural mail carrier who received a qualified reimbursement. You claimed actual expenses on a leased car. When claiming standard mileage rate, you will multiply the number of business miles driven by the standard mileage rate. Actual car expenses. You can claim the actual cost of using your car for business purposes. Allowable expenses include depreciation, car rent and parking costs, gas, oil and maintenance, insurance, lease payment, license and registration fees, repairs, replacement tires, and tolls. So all of the things that you're not allowed to claim when you're claiming standard mileage rate, you are allowed to claim when you're going actual. Even if you claim actual expenses, you are still required to track the number of business miles that you drive so that you can prorate your costs between business and personal use. And here's an example. You drove your car 15,000 miles during 2011. 10,000 were personal miles, 5,000 were for your business. Your actual cost of operating the vehicle totaled $7,000 for the year. You will figure the allowable deduction to enter on line 9 of Schedule C as follows. You will take the total business miles driven, divide that by the total miles driven of 15, and then multiply that total by the cost of operating the car. And the amount that you would enter on line 9 would therefore be $2,333. Versus business use versus personal use, the IRS requires that you maintain records to prove your business use. It's not an optional thing, isn't it? Just enough evidence that I am a real estate agent and I have to drive my car. Isn't it obvious I'm going to put a lot of miles on there? Well, yes, it is obvious that you're going to put a lot of miles on your car as a real estate agent, but you still have to prove that you did by maintaining accurate records. And one of the best ways, or the IRS's preferred way, is to actually keep a log. The log should show the dates you drove, the places you traveled to, the miles driven, and the reasons for your travel. But if you didn't keep a separate log, if you have a record or a calendar of your personal appointments, you could be logging the miles you drive on that, and that's acceptable. You may use actual expenses or the standard mileage rate in any year, but however, you will not typically be able to switch year to year. Interest on car loans. Whether you can claim a deduction for interest you paid on your car loan depends on if you are self-employed or if you are an employee. If you are an employee, you claim your business expenses on Schedule A and 2106 if it is required. And as an employee, you are never allowed to claim a deduction for any form of interest other than the two approved forms of interest, which are home mortgage interest and investment interest. Any other form of interest is not deductible on Schedule A, and that includes car loan interest incurred by an employee who has a business use car. But if you are self-employed, you can deduct the cost of interest on your car loan as a business expense on Schedule C. You would enter it on the interest expense line of Schedule C, not on the auto expense line, but it is a deductible expense there, and of course you have to prorate it by the percentage business use. Now if you sell, trade in, or otherwise dispose of your car that you used for business, you do need to report that sale to the IRS on Form 4797. And let's look at some illustrations here. Jan used her 1998 Ford Taurus in her business. And in 2011, she sold it for $3,000. In earlier years, she claimed expense deductions for the car. She also claimed a deduction for business use of her Taurus. So she has to report the sale on Form 4797. Now, even if she hadn't sold it, let's just say she's driving it out around and she totals the car, crashes it, doesn't get any money for it at all, it's just toast. The vehicle's not insured and she receives no scrap value. She still reports the sale on Form 4797. So we actually have a classwork assignment today involving a character named Snow White, and she's going to sell a vehicle and how the sale of that vehicle is going to get treated on her tax return. Allowable car expenses. If you use your car for business, you can claim actual, but never both. And then finally, figuring depreciation when you are claiming the standard mileage rate. So let's take a look at how the standard mileage rate works. And the reason the standard mileage rate is important beyond the deduction that you enter on line 9 of Schedule C is that when you finally do turn around and sell or dispose of your business use car, at the time you sell it, you're going to have to account for the business expense of depreciation and how that depreciation is reducing your cost basis in the vehicle. So for each mile that you drive that car, that you claim a standard mileage allowance, a certain portion of that allowance is actually for depreciation, and that depreciation that you are claiming through the standard mileage allowance is actually reducing your basis in the car as you go. And I started maintaining records of the standard mileage rate when I first started running tax school back in the year 2001. And back then, the standard mileage rate in play between 1994 and 1999 was 12 cents a mile. In 2000 through 2001, it moved to 15 cents a mile. And over time, it's just gradually creeped its way up. Now, in 2010, the depreciation amount was 23 cents a mile, but for 2011, it's dropped to 22 cents a mile. Commissions and fees. If you paid commissions and fees to other individuals or businesses, you report the amount here. Note that if you paid an unincorporated business $600 or more, you will need to issue a Form 1099 miscellaneous. And the same thing goes for line 11 of Schedule C with contract labor. On the contract labor line, You will enter expenses or claim a deduction for expenses paid for services performed by non-employees. And again, if you did not pay them with a credit card and they are not incorporated and you paid them more than $600, you need to issue them a 1099. Line 12 is for depletion. Unless your tax client is in the business of timber, is in the timber business, you're not going to be entering a depletion deduction on there. If you do enter a depletion deduction, you are supposed to attach Form T for timber. Note that this line refers to commercial timber businesses only and is not meant for individuals who sell timber and are not otherwise in the business of harvesting or selling timber. If you sold trees that were harvested from land that you own, you report the income from the sale as a capital gain on Schedule D. You do not enter it on Schedule C. You're not in the business of timber just because you harvest some trees and sell them. Line 13 is the line where we enter deductions for depreciation and Section 179 expenses. If you place property in service during the year, or you have listed property in service during the year, you need to attach Form 4562. Otherwise, you merely need to maintain accurate depreciation schedule, figure your depreciation amount, and enter it on the line. So in some years, Form 4562 would be attached to a business return, and in other years it's not. The years where you attach Form 4562 are years where an asset is placed in service and depreciation on that asset begins. You'll attach the form. Even if you have not placed an asset in service during the year, you still need to attach the form if any of the property you are claiming a depreciation deduction for is listed property. So that would include cars and laptop computers and so forth. The next line is employee benefit programs. You enter the cost of accident and health plans, group term life insurance, and dependent care assistance programs you paid for your employees here. Do not claim any expenses you paid for yourself. You may claim expenses you paid for your spouse or other members of your family only if they were employees to whom you issued a W-2. Note that the health insurance premiums paid by self-employed persons may be deducted as an above-the-line deduction on Form 1040, line 29. The deduction is limited to net profit from Schedule C minus deductions for the deductible part of self-employment tax or contributions for the sole proprietor's benefit to a SEMP or simple plan. So benefit program, this is if you have employees that you are paying on W-2s and you carry health insurance for them, for example, or you make contributions to benefit them to some kind of expense for their benefit that's not taxable compensation to them, that's the line you enter it on. But you would never enter an expense that benefits you on that line. But it is possible to indirectly benefit from this line. One of the things that is a rule is that on Schedule C, if you are the sole proprietor, you cannot claim a deduction for health insurance premiums you pay for yourself. Those are only deductible if you have a profit from your business and you meet a bunch of other requirements. One of those requirements is you're not eligible to participate in any other employer plan. So you have to have a profit and your health insurance is deductible provided you're not eligible to participate in any other employer plan. And the amount of your deduction cannot be more than your profit minus the deductible part of your self-employment tax and SEP or simple contributions that you make. So it's pretty restrictive, and of course, by claiming it as an above-the-line deduction, you are getting some benefit, but you're not saving on any self-employment tax that you're paying. So let's take a look at this scenario. Remember at the very start of today's class, we talked about a qualified joint venture where a husband and wife each file their own separate Schedule Cs, or the alternative is that they have a partnership together. Both of those are bad deals. If you've got a husband and wife team working together in the same business, the best deal of all is for one to be an employee of the other. This is assuming you have a profitable business. If you have a profitable business and a husband and wife file qualified joint venture Schedule Cs and they show profit, when you're done, they're both going to be paying self-employment tax. So there's really not much additional tax being paid under that methodology than if you have only one spouse be the owner of a sole proprietorship and the other spouse become their employee. So why would you do that? Well, now you're going to have to file payroll reports, which is a complexity, but it can be worth it. Because as soon as you make your spouse your employee, you are now allowed to offer an employee benefit program to that employee. And that spouse can go on health insurance that you pay for. And because you're paying health insurance for your spouse, you can claim a deduction for it on Schedule C. And not only that, you could be your spouse's dependent and be on her plan. Now you're indirectly claiming an expense for yourself on your business because your spouse is the employee that is covered by an employee health insurance plan. That employee can sign people onto her plan, and it could even be you. But if you have a qualified joint venture, you can't do that. If you have a partnership, you can't do that. Even if you have an S corporation, it's more complicated than that. So it's one of the little things I learned early on was that particular rule is allowed for. The other thing that goes on is a small business owner can employ their children. And if a small business owner employs children, it doesn't have to pay payroll tax on the wages paid to the children. And of course, you have to be able to show that it's a legitimate expense. So let's just suppose you're operating a retail store and the children are coming in and manning the cash register or stocking shelves and working for you, so you're paying them. You would pay them and you would issue them a W-2, but you wouldn't have to file payroll reports on them as long as they're under the age of 18. So there's a couple of little tricks that go on there that are reserved really for the small business owners, sole proprietors. Line 15, insurance other than health. On this line, you deduct liability, hazard, and workers' compensation insurance, but never health insurance, of course. On line 16, we have line 16A and line 16B. And on line 16A, you enter mortgage interest that was paid to banks. If you owned mortgaged property such as an office building and you receive a Form 1098 or similar statement, report the amount of interest you paid on that loan on this line. That's line 16A. But do not ever report mortgage interest you paid on your home on this line. On line 16B, you enter any other interest you might have paid in the ordinary course of your business, such as interest on credit cards used for your business, mortgage interest paid on business property where no Form 1098 was received, and any other interest you paid on business loans is reported here. So this is an important thing. If the IRS, if a 1098 is issued, you want the amount reported on line 16A to match the amounts reported on 1098. And you don't ever want the amount on line 16A to be more than the amounts reported on 1098. So if you have interest paid and it was not on a 1098, it goes on line 16B, yes. There's a question in the classroom. If a couple borrows money against their home and uses the money to invest in the business, can they deduct the interest on it? My understanding is they can do that, but they would clearly need to show the loan proceeds and how they were put into the business. An auditor would ask them to prove that. And in that case, you've got a 1098, and it's going to be secured by their home, not a business property. I would be inclined to put it on the line 16B anyway. So really, a line 16A entry is because you own a business premises. It's not your home, and you've taken out a loan on it, and you've received a 1098. If you've taken out a loan on your home, and you've put the money into the business, and you can show the tracking for that, so that you're trying to claim it as a legitimate business interest expense and not as a office use of home expense, right? It's still interest that's going to be reportable on your home, and IRS is going to be, I definitely would not put it on 16A. I think that's going to trigger an audit. I would put it on 16B, and then if you were audited anyway, show the paper trail of how that money was put into the business. Okay, Molly James is asking, once you start claiming actual expenses after claiming the standard mileage allowance, you are not allowed to go back to the standard mileage rate. Is that true? The answer is yes, if you claim depreciation. So you can start off with your car, assuming it's a car you own, and claim the standard mileage allowance. And then in a later year, after you've done that, you can switch to actual expenses. But in the year you switch to actual, I'm presuming you are also going to start claiming depreciation, because part of the actual expense you claim is depreciation. And it's the action of claiming depreciation that says you can no longer switch back to the standard mileage rate. Okay, next expense in line is legal and professional. IRS says to include on this line the fees that are charged by accountants and attorneys that are ordinary and necessary expenses directly related to operating your business. Include fees that you pay for tax advice related to your business and for preparation of tax forms related to your business. Also include expenses incurred in resolving asserted tax deficiencies related to your business. So if you're getting audited on your business, you can pay a tax preparer to represent you in the audit and claim that expense here. If you're paying the tax preparer to prepare your Schedule C, you can enter that expense here. Now clearly when you're preparing a client's tax return, the Schedule C is buried into all of the other fees you're charging. So how do you pull out and know what amount to enter there? Well, I'm usually really quite generous. I have to reserve something that is for personal, but you know, I make a pretty good call on how much I'm going to give my client on this line. And clearly it does them more good to deduct it here than it does on Schedule A by far. So I make as large an entry here as I can that is reasonable based on the fees that I've charged them. Line 18, office expense, include office expenses and postage on this line. Coming back to this, I was at an audit with a client once, and my client didn't have a receipt for what he'd paid me. And I said to the auditor, he paid me. And she said, okay. She took my testimony. That happened once. Line 18, what's that? Line 18, office expense. On this line include office supplies and postage. Line 19, pension and profit sharing plans. Enter your deduction for contributions to a pension, profit sharing, or annuity plan or plans for the benefit of your employees here. In most cases, you must file the applicable form listed below if you maintain a profit-sharing pension or other funded deferred compensation plan. The filing requirement is not affected by whether or not the plan qualified under the Internal Revenue Code or whether or not you claim the deduction for the current year. There is a penalty if you fail to file these forms on time. The first one is Form 5500 EZ. You file this form if you had a one-participant retirement plan that meets certain requirements. A one-participant plan is a plan that covers only you or you and your spouse, and that's essentially an individual 401k plan. You file Form 5500 SF if you have a small plan with fewer than 100 participants in most cases, and you file Form 5500 if the plan does not meet the requirements for the earlier two forms. So if you need more information about those forms, you can research through publication 560. Note, if the plan included you as a self-employed person, enter contributions you made as an employer on your behalf on Form 1040, line 28, or on Form 1040 NR, line 28, and not on Schedule C. And Jill is asking, allocating tax prep fees to Schedule C, would this trigger 1099 reporting requirements if the CPA firm is an LLP? Well, essentially, if you have a client who comes into you to prepare their tax return, and you're preparing a tax return that includes a Schedule C, and they're making a payment to you, they're technically supposed to 1099 you for the portion, yes, that is business. Now, if you're charging enough money that the personal return costs more than $600, what portion of that $600 is for business and what portion is for personal, they would only be required to 1099 you for the business portion of that expense. So have to be a pretty spendy return. Well, you've got, unless the tax, so we're talking about ourselves. Are we going to be expecting our clients to 1099 us? Because this is kind of an eye-opener. What, have we ever been 1099'd ever in the course of our business? Well, I have one person in the audience saying I have. Our company, the one I run, is incorporated, so there's no need to 1099 us, although we frequently get asked about that. So if you're an LLP, yeah, how much is your client paying you? Are they paying you more than $600 in a year? If they are, and if that is for business services, then yes, they should be 1099ing you. There's your answer, Jill. Line 20, rent or lease. Beginning with line 28, this is another one of those two-part lines. Line A, vehicles, machinery, and equipment. If you rented or leased vehicles, machinery, equipment, enter the amount here. If you lease a vehicle for a term of 30 days or more, you may have to reduce your deduction by an inclusion amount. We talked about how to figure inclusion amounts. When was that? That wasn't on the rental property. I think it was on depreciation. We talk about inclusion amount and depreciation made easy, and the reason we talk about it there is the inclusion amount is intended to impose the limits on the depreciation that are on automobiles. So there's a maximum amount of depreciation you're allowed to claim in a year on an automobile. And if you lease a vehicle, The inclusion amount is intended to have the same effect. It reduces the amount you're allowed to deduct. And how you figure an inclusion amount, we talk about that in our class called Depreciation Made Easy. Okay, line 20B, other business property. Amounts you paid to rent or lease office space or a building are entered here. Do not include amounts you spent for office use of your home on this line. Line 21, repairs and maintenance. Enter on this line the cost of labor and supplies used to maintain or repair business property. Do not include any of the following expenses on this line. Repairs to office use of home. Improvements to property that change or extend its useful life, because that needs to go on a depreciation schedule, or the value of your own labor. Line 22, supplies. Supplies are items that you consume or use up. And examples include small tools with a useful life of 1 year or less used by a furnace installation business, or shampoo, conditioner, and perming solution used in a beauty salon. In most cases, you can deduct the cost of materials and supplies only to the extent that you actually consumed and used them in the business during the year. However, if you had an incidental materials and supplies on hand for which you kept no inventories or records of use, you can deduct the cost of those that you actually purchased during the year, provided that the method clearly reflects your income. You can also deduct the cost of books, professional instruments, equipment, etc. if you normally use them within a year. However, if their usefulness extends substantially beyond a year, you must generally recover their costs through depreciation. So we're going to come up, I think I'll finish this line, supply line. I've got quite a bit more to say about it, but we'll finish talking about it and then we'll break for our intermission. And what else I have to say about this line is there are certain situations where you're going to enter an expense on this line that may not feel too intuitive. And one of those is meal expenses of a child daycare provider or an adult foster care home provider. There is a meal expense line on the form. Typically that line is meant for meal and entertainment expenses when you are either entertaining clients locally, taking employees to meetings, traveling out of town. And when you have that kind of meal expense, it's typically subjected to a 50% limit, or in the case of transportation workers, an 80% limit on its deductibility. But there are situations where when you pay for a meal expense, it can be fully deductible. And one of those would be, obviously, you've got food that's being consumed by patients in your nursing home or your foster care home, or by the children that are in your daycare facility. And where should you enter that? Well, the IRS doesn't specifically tell you to enter them on this line, but this is the line that I put it on. It makes the most sense to me because it's something that gets used up or consumed in the ordinary course of the business. It's also the place I put coffee and creamer for my office. All right. So family daycare providers, let's talk about them a little bit. Family daycare providers are not the same as foster care home providers. They are two different categories of business. So what I'm about to talk about applies only to family daycare providers. Beginning in tax year 2003, family daycare providers are allowed to use a standard meal and snack rate rather than the actual cost of the food that they feed the children that they're caring for. The standard meal and snack rate can be used for a maximum of 1 breakfast, 1 lunch, 1 dinner, and 3 snacks per eligible child per day. Note that if a family daycare provider receives a reimbursement for a particular meal or snack, that daycare provider can deduct only the amount that they exceeds the amount of the reimbursement. Family daycare providers, who is a family daycare provider? A family daycare provider is a person engaged in the business of providing family daycare. Go figure. What is family daycare? A family daycare is a child care provided to eligible children in the home of the family daycare provider that meets all of the following requirements. The child care is not medical. A transfer of legal custody is not involved, and the child care generally lasts for less than 24 hours each day. Who is an eligible child? Eligible children are minor children receiving family daycare in the home of the family daycare provider. Eligible children do not include children who are full-time or part-time residents in the home where the child care is provided, or children whose parents or guardians are residents of the same home. Here is an example. A family daycare provider's own children, and any children who live in the family daycare provider's home on a full-time or part-time basis, are not eligible children, even if they receive daycare services in the family daycare provider's home. So what are the standard meal and snack rates? Well, they're listed on the following table. This comes from USDA, and it is updated each year on July 1st. If you are anywhere in the contiguous United States, each breakfast you feed the children is worth $1.19. Each lunch is $2.22, each dinner is also $2.22, and each snack is 66 cents. Alaska is more expensive at $1.89, $3.60, $3.60, and $1.07, and Hawaii is somewhere in the middle at $1.38, $2.60, and 77 cents. A family daycare provider who chooses to use the standard meal and snack rates for a particular tax year must use the rates for all deductible food costs for eligible children during that year. For more information, oddly enough, this particular piece of information is included in the Business Use of Your Home publication, publication 587. Here is an illustration of how it would work. Sandy Muffet runs Little Tuffet's Daycare from her home. During the year, she cared for the following children who were with her for the following number of days and meals. She has Jack, Jill, Hansel, and Gretel, and the number of meals each of these children ate during the year. So she would have to keep a log to track that, wouldn't she? And the IRS actually has a log. I've seen it. I should have put a link in here for it, but I've seen the log, and it works something exactly like this, but it goes by week. List each child, the meals you fed each child on each day of the week, total up the months or total up the week, and then finally total up the year. So it's a pretty detailed log that they want you to keep. I've done a little bit simpler version here. I've got the breakfasts, the lunches, the dinners, and the snacks for each of these 4 children, and I've totaled them at the bottom. And the next step is to go over and count or calculate what the deduction is going to be. Obviously, Sandy Muffet operates her daycare business in the contiguous United States because those are the numbers that we're using. She's got 250 breakfasts. The total amount there she gets for that is $297.50. She gets $555 for lunch, $111 for dinner, and $330 for all those snacks for a total deduction of $1,293.50. Yes, question. Why would someone choose the standard meal and snack rate over actual expenses? Well, a family daycare provider, how often do you think they go to the supermarket and buy food only for themselves and then have a separate cart with food only for the children? I suppose they could do that, but they're trying to divide it in the cart. And then it gets on the shelf at home and they're worrying how much of the food on the shelf they ate, how much of the food was for the children. It can be done, of course, but it would be difficult to track. And so that is why they came up with the standard meal and snack rate, just for simplicity. And quite frankly, I have found the rates to be pretty generous. I think that they're more than it's actually going to cost to feed children, at least, you know, the quality of food most people are going to be buying them. And the line that we're on to now is the tax line. And line 23 of Schedule C, what kind of taxes am I supposed to enter on that line? Well, on that line, you would enter state and local sales taxes imposed on you as the seller of goods or services if you collected this tax from the buyer. You must also include the amount collected in gross receipts or sales on line 1. Now, the thing with sales taxes, IRS is saying on one hand put it on and on the other hand not put it on, and they seem to be having a difference in their wording. So most states have sales tax where you're collecting it, and the rule is that if you're collecting the state sales tax basically as an agent for the state government, and you're holding it and turning it over to the state government, they don't want you to include that as income of the business, and they don't want you to claim it as an expense of the business either. But if the sales tax itself is actually imposed on you as a seller of goods and not on the consumer, then they do want you to include that in income, and then they want you to record the payout as a tax on line 23. The other kind of tax to report on that line is real estate and personal property taxes on business assets. Personal property taxes are assessed in virtually every state on the assets of a business, and it's assessed not just on vehicles, but also on furniture, equipment, even papers, pens, and other supplies. The personal property tax report you file with your county, city, or state. After you've done that, you'll typically get an assessment. Whatever that assessment is, you pay it, and then it's deducted on this line. Licenses and regulatory fees for your trade or business paid each year to state and local governments. However, some licenses, such as liquor licenses, have to be amortized. So if you have to pay a high amount of money for a license that gives you the privilege of conducting business, that license has a value, and that value needs to be amortized. So they're comparing a license to a tax and saying that a license that is like a tax is deductible, but a license that is buying you something, like an ability to run a particular type of business, is different. And I've heard for years that taxi cab licenses in New York are really expensive, that they're worth a bunch of money. So that's probably the type of thing they were looking at as well. Next one is Social Security and Medicare taxes paid to match required withholding from your employee's wages. Reduce your deduction by the amount shown on Form 8846, line 4, credit for employer Social Security and Medicare taxes paid on certain employee tips. We will cover that exact credit next Thursday in our class called Federal Credits for Business. But essentially the way that form works is if you are an employer who has employees who are receiving tips, those employees are supposed to report their tips to you, and then you need to file payroll reports showing and paying in the tax that is owed on those tips. And when you do that, you're allowed to claim a credit against that tax that you paid on your employee tips. And it's done through this particular form. Now, if you claim a credit for a tax that you've paid, it stands to reason you must reduce your deduction by the amount of credit that you're claiming against it. And so that's what the sentence is saying, is if your payroll tax is totaled $10,000, but you're claiming a credit of $1,000 against the tax paid, you're only going to be allowed to claim a deduction for the difference. And what else can I say about this line? Here's a big thing I can say about this line. Most people who keep care of their own books, and even most bookkeepers that I run across, totally get the tax withholding messed up. When you pay an employee their wage, as the employer, you are supposed to be paying a matching tax on top of that. 6.2% Social Security, 1.45% Medicare. That's a tax that's imposed on you on the wages you're paying them, and you can deduct that as a tax in this section of the form. But the other thing that goes on is as the employer, you act in trust of the government, and you withhold taxes from that employee's pay and turn those taxes over to the government. The taxes that you're withholding from the employee's pay are not taxes that you are paying. They are taxes the employee is paying. Okay? And so it's really important to understand that difference when the tax preparer is completing the tax return. So one of the things that I do is I assume when I look at a P&L that's been brought to me by a client that what they're probably doing is showing the amount of tax paid out to the government as including amounts that are actually the employee's share of taxes as well as employee withholding on taxes. So I don't have an illustration of this here, but let me kind of just scribble on the side here and show you what I mean. So we go on here, and let's just suppose we have an employee who has been paid $10,000 on their W-2 for the year. That's the gross amount that they've been paid. And during the year, if you can just picture the W-2, box 1 is $10,000. Box 2 is their federal withholding, and let's just suppose we held out $500 of federal withholding during the year. And then, of course, we have Social Security withholding that would be down here. And Social Security withholding for 2011 would be $420. And Medicare withholding would be $145. And let's just forget the state at this point. So I add these up, and I got 500 plus 420 plus 145 is $1,065. So the employer is responsible for holding out $1,065 of tax for the employee. Next to this, the employer has other obligations. Among those are the employer's share of the Social Security tax, which in this case would be 6.2% or $620, right? Plus, the employer would be responsible for paying an additional $145 on the payroll paid to that employee. So how is this going to look, or how is the employer going to deduct these amounts on the employer's tax return? Well, the employer is going to claim a tax deduction for these two combined amounts, 145 plus 620, as a tax paid. So $765 is the amount that the employer would enter as a tax paid on that employee. And the amount that the employer will enter as wage paid is going to be $10,000. There's nowhere on the tax return of the business owner that the business owner claims a deduction for this tax paid for the employee. It's not the employer's expense. The employer's expense is the $10,000 of gross wage and the matching employer share of the taxes paid on that wage. And when clients bring in their profit and losses, invariably what they do is they will have $10,000, they'll subtract out the $1,065 and tell me that the payroll they paid their employee was $89.35 and that the taxes they paid is going to be $1,065 plus $765 for $1,830. Well, this down here is correct. You're going to pay $765 of tax and include that as a tax expense. And you're going to take $10,000 as a wage expense paid out during the year. You should not be using $89.35 as the wage expense paid for the year and $1,830 as the tax expense. So how do I make sure I get it right? I ask my customer to bring me the W-3 form that was transmitted to the government along with all of their W-2s. And I compare that W-3 form and all of the taxes that I see that should have been withheld on it to the actual tax deductions being claimed on the return, and I look for a balance. Now, if you're dealing with taxes at the state level, you also need to ask for the state payroll forms. So here in Oregon, we have 4 reports that are filed for each quarter. And at the federal level, you have 4 reports, 1 for each quarter, plus you have the 940 FUTA at the end of the year. So the W-3 is really a summary of the 941s, and then the 940 is a separate report showing you the FUTA tax. At the state level, there may not be a year-end summary. You may have to look at the individual quarters. But that's something to be on the lookout for because they all do it. No, this is 420 is correct because for 2011, the employee share is 4.2%. Yeah, so for all of history, it's been 6.2% on both sides, but for 2011, the employee gets 2% reduction. But unfortunately, we employers don't get that same reduction, so we're still paying the full side. All right, so when we talk about Social Security and Medicare taxes, please be sure that you are entering only employer share of those taxes and not the employee's share. And the best way to do that is by asking to see the 941 reports, the 940 report, and the W-3 report. My experience with my clients is that I'm the first person who has ever asked them for that. So they're confused by it. And then when they bring it in, I invariably see that the books do not match those reports. And why is it important for the tax return to match the reports? Well, if you file a tax return that says your payroll was $8,000, but you issue a W-2s totaling $10,000, is there something in the IRS system that might pick up on that? I mean, there's somewhere something is going to notice that there's a disparity. Now, how much of a margin of error they allow for, I don't know. I'm sure there is a margin of error just because of different accounting methods. You could have W-3s going out for the year that can differ from the amount reported on the tax return just because of differences in accounting method. But still, you're going to have a certain margin of error, and beyond that, I think it can trigger certainly a CP 2000 letter or a visit from the auditor. The forms to ask for are, let me jot this up for you. So the form that the employer, I have a webinar attendee asking, what are the forms again? So the W-3 is the master copy. When an employer files W-2s, there is a cover sheet that goes with the W-2s called a W-3. And the W-3 looks like a W-2, except it's the total of all of the W-2s that employer issued for the year. So the W-3 is usually a pretty big number. So that's the total of all of the W-2s. And then on top of the W-3, I like to see the 941s for all 4 quarters. And I like to see the 940 for the year. And then at the state level, whatever the state forms are. And I could tell you what Oregon calls ours, but that doesn't mean much to you in your state. So you'd need to look into your state to see what they call them. But in Oregon, there's 4 forms a year. And at the state level, you're going to have state unemployment tax at a minimum. Some states like California have what is it called? There's a fund that the employer pays into and a fund that the employee pays into. Disability fund, yeah. So there's different funds like that that get paid into. There are various forms of taxes, and you just have to research your own state at your state level to see what it is that you're paying, your client would be paying into at that level. Okay, next one in line. Oh, well, federal unemployment tax is one of those taxes that we've just been talking about tied to payroll, and the federal unemployment tax is called FUTA, F-U-T-A. That is the name of the tax, and then the report that it is reported on is 940. The FUTA report is due each year on January 31st. So the 2011 FUTA report was due to be filed on January 31st, 2012. But all of the 941 reports, except the final quarter, would have been due during 2011. So there's a report due April 15, July 15, was it? Must be October 15, and then January 15. And then finally, federal highway use tax. If you paid that tax, you put it on this line. And also contributions to the state unemployment insurance fund or disability benefit fund, because if they are considered to be taxes under that state's law. But do not include the following taxes on the tax line. Federal income taxes, including your self-employment tax. However, you can deduct a portion of your self-employment tax on Form 1040, line 27. The portion you can deduct is the employer share, which would be the 6.2% plus the 1.45%. On the front line, line 27 of Form 1040, but never on Schedule C. Also do not deduct on Schedule C estate and gift taxes, taxes assessed to pay for improvements such as paving and sewers, taxes on your home or personal property use. If those are deductible, they belong on the Office Use of Home Form 8829 or on Schedule A, but not on Schedule C. State and local sales taxes on property purchased for use in your business. Instead, treat these taxes as part of the cost of property. And state and local taxes imposed on the buyer that were required to collect and pay over to state or local governments. These taxes are not included in gross receipts or sales, nor are they deductible as an expense. So this is the opposite of what we had up at the very top here, that depending on how your state goes about having you collect sales tax, if you're withholding it from collecting it from the buyer on behalf of the state and then forwarding it to the state, do not include it in your income, do not include it as an expense. But if it's being assessed on your sales against you, and after you've brought in your sales, you turn around and pay the tax, then you include it as a tax going out. Line 24, travel, meals, and entertainment. There's a lot to say about this line, all kinds of rules that apply to this line, and they apply to employees as well as to self-employed people. Firstly, travel. On this line, you would enter the cost of airfare, taxi, train, bus, hotel, local transportation while traveling away from your tax home. And on line B, you enter deductible meals and entertainment. Enter your meal and entertainment expenses after deducting the non-deductible amount. For most people, the non-deductible amount is 50% of the allowable expenses for meals and entertainment. However, if you work as a transportation industry worker, such as an airline pilot or attendant, a railroad employee, or in trucking, you may be entitled to claim 80%. We'll talk more about that in a bit. To claim travel expenses, you have to meet the tests for claiming travel expenses. And the first test is that you have to have a real, regular place of abode, a place that you live in a real and substantial sense. You have a regular place of abode if all of the following is true. You work in the same vicinity as your claimed abode and use it while doing business. Your living expenses incurred at your claimed abode are duplicated when you're away on business. So if you don't have an abode and you're living on the road all the time, you can't ever say you're duplicating expenses because the only expense you ever have is where you are now. You're not paying for it where you're not. So the idea of having travel expenses, you're paying for two things. You're paying for your regular abode, and now you're paying more again because you're traveling. Also, you must not have abandoned the vicinity in which your place of lodging and claimed abode are both located, or you must have family members or a member, marital or lineal, currently living at your claimed abode, or you use the claimed abode frequently. You also have to have a tax home. Your tax home is your regular place of business or post of duty, regardless of where you maintain your family home. It includes the entire city or general area where your main place of business or work is located. You can claim the cost of expenses you incur while traveling away from your tax home overnight. If you do not have a regular place of business or post of duty, and there is no place where you regularly live, the IRS considers you to be a transient, and your tax home is wherever you happen to work. As a transient, you can never be away from your tax home, so your travel expenses are never deductible. So how do you have a main place of work, or what is your main place of work? Well, if you have more than one place of work, considering the following when determining which one is your main place of work. First, the total number of hours or time that you ordinarily spend working at each place, the total level of your business activity in each place, and whether your income from each place is significant or insignificant. Years and years and years ago, I had a tax preparer call me. This was before I was running a tax school. She just called our business and she said, yeah, I'm a tax preparer and I live in Bend, except in tax season I come to Portland and then I work as a tax preparer in Portland. Can I claim my travel expenses? And the first thing that was going through my mind is you're charging people to prepare taxes and you're asking me this question. But the second thing that went through my mind was, well, do you have a regular job in Bend? Because if you live in Bend all year long, but you never work in Bend, you basically live there in a semi-retired mode, and then in the tax season you go to another city where you work for the tax season, earn a bunch of money, and then go back to Bend, then technically Portland is your tax home. So that's what the IRS is getting at there. They want to know where it is you do the majority of your work, the most important part of your work, where you spend the majority of your time working and earn the money. That's your tax home. And your tax home can be a different place than your abode where you live. Now, in order to be traveling away from your tax home, you also need to be, you have to be traveling away from your tax home, but you also have to have a regular abode. You kind of have to have two things, a tax home and an abode, even if they're different. Traveling away from home. You are traveling away from home if your duties require you to be away from the general area of your tax home substantially longer than an ordinary day's work, and you need to sleep or rest to meet the demands of your work while you are away from home. This rest requirement is not satisfied by merely napping in your car. You do not have to be away from your home for a whole day or from dawn to dusk as long as your relief from duty is long enough to get necessary sleep or rest. So IRS Publication 463 does a very good job of describing tax home and gives illustrations of a person who is meeting the definition of needing to be away from home long enough to qualify for rest. It has other examples of people who don't meet the tests. I've got two of them in today's session, but if you want more, you can go back to IRS Publication 463 and read more. So the first example is qualifying travel. You are a railroad conductor. You leave your home terminal on a regularly scheduled round trip between two cities and return home 16 hours later. During the run, you have 6 hours off at the turnaround point where you eat 2 meals and rent a hotel room to get necessary sleep before starting the return trip. Even though you were gone only 16 hours, you are considered to be away from home and you can claim travel expenses. Example number 2, however, does not qualify. In this example, you are a truck driver. You leave your terminal and return to it later the same day. You get an hour off at the turnaround point to eat. Because you are not off to get necessary sleep and the brief amount of time off is not adequate for rest, you are not considered to be traveling away from home. Temporary assignment or job. If you are temporarily assigned to a job at a location away from your tax home, you can deduct your temporary living expenses as travel expenses subject to the following. Number 1, your assignment must be considered temporary in order for you to claim the expense. A temporary assignment is one that realistically expect will last 1 year or less and does in fact last 1 year or less. If your assignment is indefinite, that is expected to last more than 1 year, the location of your assignment becomes your new tax home and the cost is not deductible. In other words, the IRS would say that you've moved there. You could deduct moving expenses because you've moved there and you're going to meet that 39 weeks, presumably, out of 12-month test. So there's a point where it's temporary and you can deduct all the costs. If you're not sure whether it's going to be temporary or permanent, then it's indefinite and you can't deduct any travel costs. And if you think it's going to last more than a year, what you can do is move there and claim the cost of the move. But you're not going to be able to claim temporary living expenses. How do you determine temporary or indefinite? To determine if your travel is temporary or indefinite, you should apply the following rules. If you are indefinitely assigned to a work location, that work location becomes your tax home. You must determine if your assignment is indefinite or temporary when you start work. You may claim temporary living expenses while you are away from home up until the day you first become aware that your assignment has become indefinite or will last more than a year. Members of the armed forces who are on permanent duty assignment overseas are not traveling away from home. Naval personnel assigned to ships with eating and sleeping facilities are considered to have a tax home aboard ship. If you are on a probationary assignment with the understanding that you will keep your job upon satisfactory completion of the probationary period, your assignment is considered indefinite for travel purposes. So these rules, a lot of them look like they're geared to employees, but they're also important for a self-employed person. Number one, a self-employed person could travel and want to be able to claim a travel expense. So we have to look about whether or not that individual who is self-employed and paying for their own costs of travel, can they deduct it? So we have to look at, are they traveling away from their tax home? Are they duplicating expenses because they have an abode? Is the assignment that they've accepted temporary, that is lasting 1 year or less? It is reasonable to expect that a person who runs their own business could accept an assignment out of town, out of their hometown, that would last more than a year. That's easy to see. The other side of it is that a large enough small business owner could have employees that they're sending off on business trips. And are they going to be able to claim expenses that they pay for their employees' travel? If you pay travel expenses for an employee and the expenses you pay for the employee do not meet the conditions necessary for being deductible, then the IRS will deem those to be compensation to the employee, and you'll have to gross up their W-2 by the amount of non-allowed expenses that you paid on their behalf. So it's important for both sides to understand what it means by temporary or indefinite, what qualifies and what doesn't. Next, we have going home on your days off. This information comes from page 177 of Pub 17. If you travel home on days off to visit your family, you can claim travel expenses equivalent to what meals and lodging would have cost you had you stayed in your temporary home. This rule applies only if you are assigned to a temporary work location away from your home. If your temporary assignment is expected to last more than a year, you cannot claim the cost of expenses you pay for your temporary home or meals. Note that if your assignment away from your family home is indefinite or is expected to last more than 1 year, you cannot deduct any costs associated with traveling to your family home on your days off. However, if you travel away from your tax home to the vicinity of your family home for legitimate business reasons, now you can deduct the cost of business travel to the vicinity of your family home, because that would just be purely coincidental. So, for example, I have a friend right now. He is, of all things, an expert witness on computer forensics. And he travels around the country to research or do investigatory work for people who are suing each other. He goes into computer systems and looks for evidence and deciphers it, and then he testifies on it. And he usually goes away for a couple, 3 weeks at a time and lives in a hotel while he's doing all of this work and testifying in court. Well, right now it happens to be the case that he's testifying in Washington, D.C., and his family lives there. So it's a bonus for him. He will have legitimate travel expenses while he's in Washington, D.C., and while he's there he can visit his family and write it all off. It's completely legal. But you know, if his permanent home became Washington, D.C., for whatever reason, it was the place he ended up doing the majority of his work, then he would only be able to deduct expenses when he travels away from Washington, D.C. and not to it. So this is what the rule is getting at, is you have to identify where your tax home is. Your tax home may be the same as your family home, and it may be different than your family home. And if it's different than your family home, then if you take legitimate travel to your family home, you can deduct that. But traveling to your family home on your days off is not deductible if your family home and your tax home are two different places. Deductible travel expense. The IRS considers travel expenses to be the ordinary and necessary expenses of traveling away from home for your business, profession, or job. An ordinary expense is one that is common and accepted in your trade or business. A necessary expense is one that is helpful and appropriate to your business. An expense does not have to be required to be considered necessary. If the trip is primarily for business, you can deduct all your necessary travel expenses, but you may not deduct costs associated with personal side trips or to lengthen your stay for personal reasons. And these are some illustrations I've used for years. First illustration is a trip primarily for business, and you're going to Hawaii, because this time of year it's called, we're calling it January here in Oregon. The weather is rainy and awful like January, so we're calling it January. And in January, there's a few people that go to Hawaii for vacation. So you travel to Hawaii for a convention. And the convention lasts 3 days, but you stay a week to enjoy a short vacation. You may deduct the cost of traveling to and from Hawaii and the cost associated with meals and lodging surrounding the convention. The cost for meals and lodging you incur during your additional vacation time is not deductible. Well, that's perfectly reasonable, don't you think? Now let's look at another situation where the trip is primarily for personal reasons. If your trip is primarily personal, you cannot deduct any of your travel expenses. But if you incur direct expenses while on your trip, you may deduct the cost of those business expenses. So here we are in Hawaii again. This time it really is a vacation, not for a convention. And while in Hawaii, we attend a one-day seminar related to our business. You cannot deduct any of the costs associated with travel to or from Hawaii. You cannot deduct the cost of lodging or meals while in Hawaii, but you can deduct the cost of attending the seminar. There's a question coming up from Ralph. Are meals ever 100% deductible? Well, earlier I described a situation with meals for children in a child daycare or the cost of feeding meals to patients in a foster care center. Those would be examples where food is 100% deductible. There's no point where a business person traveling gets 100% no. Now, if you are an employer who provides meals for your employees on the business premises and for the convenience of the employer, that is a tax-free fringe benefit you can give to the employee and write off in full. There's some very narrow definitions of what is for the convenience of the employer. An example of that would be we are staying late for a meeting. It's a really important meeting. All the staff has been asked to work late till midnight. We're bringing in food to feed everyone so that they can stay late and work. That would be an example of a meal that's 100% deductible because it's on the business premises for the convenience of the employer. It's not an ordinary expense, or ordinary is not the word. It's not a regular expense. It's an infrequent thing. But in general, there is either a 50% limit or a 80% limit that will apply to meals. Yes? Well, that's the very next illustration I'm coming to. What happens if you stay an extra day because it's cheaper or the same? So here's the illustration, the next illustration. You travel to Hawaii to attend a 4-day seminar. Your spouse decides to travel with you because the cost of bringing your friends and family members is never deductible. But we have an illustration here. You travel to Hawaii to attend a 4-day seminar. Your spouse decides to travel with you because of a package deal you were able to purchase. The cost of staying in Hawaii for 7 days is the same as the cost of staying for 4. So this is actually an illustration about how you can't deduct your spouse's travel, but at the same time it's an illustration of what happens if you stay longer but it doesn't cost anymore, or it even costs less. What then? So in this illustration, you're traveling to Hawaii for 4 days. Your spouse comes with you. Because of a package deal, you were able to purchase the cost of staying in Hawaii for 7 days, and that cost is the same as if you'd only stayed for 4. You can deduct all the cost of travel, meals, and lodging for yourself, but you cannot deduct the cost associated with your spouse traveling with you, and this is true even if your spouse assists you with performing your duties. Now, there's an exception to this rule for self-employed people. If your spouse is your employee and you are paying them on a W-2 and you bring them along in the ordinary course of the business for them to perform services for you as an employee, then you could deduct their costs. Your example is I went for 5 days and I stayed a 6th day because it's cheaper to stay the 6th day than to stay the 5. And you would be able to deduct it all. Yeah. Now we're going to get into travel outside of the United States because when we travel outside of the United States, there's more scrutiny. And all in all, this is a lengthy topic that I've tried to squeeze into just a few minutes here in today's class. But Publication 463 literally has an entire chapter on travel and how you identify when travel is deductible and what percentage of travel is deductible. Particularly when you start traveling outside of the United States, it actually has you start doing formulas to figure how much you went out of your way, how much time was spent to arrive at a bottom line number of what you can deduct. And I'm not showing you any of those formulas. But I'm telling you where to go to find them. Publication 463. Yes. Well, there's a comment in the classroom like, I understand the part where you travel to Hawaii and you take your spouse, you can't deduct the cost of the airfare and the meals, but the hotel's the same either way. And I would agree with that. If there's no difference in the cost of the hotel room, whether your spouse is in there with you or not, then you're not deducting an extra expense because of the spouse, and you would just deduct what you would have anyway. But what you're not allowed to deduct is anything extra that costs to bring your spouse with you. And this is pretty well-tested law. You're not going to be able to get it through an audit in any way, shape, or form unless you can show that your spouse was your employee. If the spouse was the employee, then you can do it, but otherwise, definitely not, even if they were performing crucial duties. So my recommendation is if they're performing crucial duties, put them on a W-2 and pay them, and then you can deduct their travel costs. Okay, so let's now look at travel outside of the United States, because for travel outside of the United States, things are much more serious. They give it much more close scrutiny. IRS rules governing the deductibility of expenses for travel outside of the United States are different and more restrictive than for business travel inside of the United States. IRS says that the United States includes the 50 states and the District of Columbia. How much of your travel expenses you can deduct depends in part upon how much of the trip is outside of the United States and was business related. You can deduct all of your travel expenses of getting to and from your business destination if the travel was either entirely for business or was considered entirely for business. So what does it mean, considered? Even if you did not spend your entire time on business activities, your trip is considered to be entirely for business if you meet at least one of the following 4 exceptions. Exception number 1, there is no substantial control. This means your trip is considered entirely business if you did not have substantial control over arranging it. You do not have substantial control over the trip if all of the following apply. You are an employee who was reimbursed or paid a travel expense allowance, and you are not related to your employer, and you are not a managing executive. Exception number 2, you are outside of the United States for no more than a week. Your trip is considered entirely for business if you were outside of the United States for a week or less, combining business and non-business activities. 1 week means 7 consecutive days. In counting days, do not count the day you leave the United States, but do count the day you return. Exception number 3, less than 25% of the time away from the United States was spent on personal activities. Your trip is considered entirely for business if you were outside of the United States for more than a week, but you spent less than 25% of your total time outside of the United States on non-business activities. So that's a pretty generous deal. I'll take a 2-week business trip and I'll slap less than 25% extra on the edge to recreate. Or maybe I'll recreate in the middle. They're okay with that. Exception number 4, vacation is not a major consideration. Your trip is considered entirely for business if you can establish that a personal vacation was not a major consideration, even if you have substantial control over arranging the trip. And then travel primarily for business. If you travel outside of the United States primarily for business, but spend some of your time doing personal activities, the following rules apply. You can deduct the business portion of your cost of getting to and from your destination, but you must allocate or prorate other travel costs between your business and personal activities to determine your deductible amount. And this is a point where they had a really big formula here. Someone's in France, they could go home to New York, but they go to Ireland on the way and visit family. And so there's like this detour, and they had a formula for figuring out how much they're going to get to deduct for that. Doesn't that sound like fun? Do the formula? I did not throw that in here for your benefit. Okay, on to meals. Unless you meet the rules for business entertainment, you cannot deduct the cost of meals unless it is necessary for you to stop for sleep or rest to properly perform your duties. The IRS does differentiate between meals and entertainment. And the IRS says a meal is something, it's food that you're eating while you're away from home. You're traveling. You have to eat, so you're eating meals. When you eat meals locally, usually, involved in a business discussion, IRS typically classifies that as entertainment. So meals eaten locally are entertainment, when meals when you eat away are meals. So to have an allowable meal expense, or if you do have an allowable meal expense, rather, you can use the actual cost of meals, or if you are traveling away from home, you can claim the actual cost of meals or the standard meal allowance. The standard meal allowance covers the daily cost of your meals and incidental expenses while you are traveling away from your home on business. Incidental expenses include the costs you pay for fees and tips given to porters, baggage carriers, bellhops, hotel maids, stewards, and stewardesses, transportation between places of lodging or business and places where meals are taken if suitable meals can be obtained at the temporary duty site. This is a question sometimes we get in our basic tax course, because in our basic tax course I've always had this illustration where you have a business meeting at a hotel, and then you travel to dinner at a restaurant, and you pay $25 for the cab ride there and back, and then $100 for the meal at the restaurant. And what is the deduction? And IRS says, well, it depends. Is the taxi drive transportation, or is the taxi drive part of the meal? And IRS says if the meal could have been eaten at the hotel because there was a full restaurant there, therefore making the travel unnecessary, then the travel to the unnecessary eating location would become part of the cost of eating at the other location. But if you can't eat where you are, which is why you get in the taxi and go somewhere else, then you can deduct it. That's what this sentence is saying. Mailing costs associated with filing travel vouchers and payment of employee-sponsored charge billings are also incidentals. But incidental expenses do not include expenses for laundry, cleaning, and pressing of your clothing, lodging, taxes, and or the cost of telegrams or telephone calls. Next, we're going to look at the daily per diem rates. Daily per diem rates vary according to the city and the country you are visiting. The rates are published by the U.S. government and updated at least annually. There are basically 3 different sites that you go to for per diem rates. There is travel inside of CONUS, which is the continental United States. There is travel in the United States, but not in CONUS. So that would be the U.S. territories, Hawaii, Alaska. And then there is everywhere else that's not the United States or its territories. And you have 3 different sites for 3 different types of per diem rates. Typically, the per diem rates for CONUS are updated each year in October. And for the last 3 months of the year, taxpayers can use the new per diem rates effective October 1, or they can continue to use the old rates that were in place for the rest of the year, or the earlier part of the year. The 2011 standard rate, meal rate, for most areas of the country is $46, and that has not changed for some time. We've been in this lousy recession since 2008. We're trying to crawl and scrape our way out of recession. But ever since we went into the recession, the daily rate has gone down, actually. It hasn't gone up anywhere that I've noticed, but I have seen it go down in a few places. IRS publication 1542 lists rates by region for high-cost areas of the country. So the daily rate for most areas of the country is $46, but that's really, I like to think of that as the rural areas. Anytime you get into a major metropolitan area, you're going to be in a high-rate area. And the higher rates vary anywhere from a low of $51 up to a high of $71. And if you look at some of the areas in the country and what the per diem rates are for them, I have them in here for you. Los Angeles, Seattle, Las Vegas, Chicago, and Washington, D.C. are all high-rate cities at $71. Portland, Oregon, where our school is located, Philadelphia, and San Antonio are all $66 cities. Milwaukee, Wisconsin, and Salt Lake City, Utah are $61 cities. Virginia Beach, Virginia, and Vancouver, Washington are examples of $56 cities. Now, it may be that you are close to a city but not actually in it. Can I cheat? Can I say I'm in Seattle when I'm really not quite in Seattle? And the answer is sort of. It depends if you're in the county. So here I just pulled up a cutout from the defined location for some areas inside Arizona. And you can see that there is a meal rate assigned to Phoenix and Scottsdale that includes Maricopa County. And if you are anywhere inside of Maricopa County, you do get the $71 a day. So if you're not in Phoenix, but you're in a suburb of Phoenix, you're still going to be able to go with that higher rate. And of course, Seattle sits inside King County. And King County is a pretty big county. It covers quite a bit of area, and there's a lot of towns in it. Now, for per diem rates for travel outside of the continental United States, you don't use the CONUS rates. Instead, you go to this defense travel, and it's maintained by the Department of Defense. And for travel to foreign countries, you then go to the Secretary of State site. And some examples of the higher rates you will find on the Secretary of State site include Vancouver, Canada. You get $120 a day to pay for your food while you're in Vancouver. And I get up to Vancouver frequently, and it's not that much more money than Portland. So that's a pretty good deal. No, that's just the food. That is the meal-only rate. But look at London, England, where the Olympic Games start in the next month. $182 a day for London, and I bet it's going up with the Olympics. Kuala Lumpur in Malaysia, even, is $77 a day. Hong Kong, $144. The island of Kauai in Hawaii is $92 a day, and Fairbanks, Alaska, $86 a day. So you can see that once you're outside of CONUS, the rates get quite high. Now, when you're dealing with an area outside of CONUS, you also have to be worried about the months because these rates do update depending on the months. Now, to show you how easy it is to get this information, I will share the internet with you and take you to these sites. I haven't preloaded them or anything. I'm just going to show you how easy it is to get to them if you're not experienced with doing it. So I've just landed on the LMS where you joined our class, and I'm going to open up a new tab here, and I'm just going to type daily per diem rate. I don't even think I have to do that. I think I just have to go per diem rates. See what my search engine brings up. Oh, there it is. That was a lot of work. Oh, look at this now. If I want to find a particular state, I just have to click on the state. Let's try Hawaii. I have someone in my classroom who's come all the way from Hawaii to come to our class today. So we land on this particular site, and we need to select the state. It's already highlighted. You can see it's defaulted to June 2012 because that's where we are. But if I need to know what it cost for Hawaii in September of 2011, I need to select that date, and then it pulls it up. Now, when we look at this page, you'll notice that there's a number of columns. And it's important that you understand the meaning of each column. For example, this column says the maximum lodging rate is $177 a day, and the maximum local meal rate is $93 a day. And then we have this proportional meals and the local incidental. If you take local incidental and add that to proportional meal, you get the $93. So $93 is the number you get. And then over in this column, it says maximum per diem rate, $293. This is not something a self-employed person claims for themselves or an employee claims for him or herself as an expense. When you are self-employed or you are an employee claiming your own travel expenses, you are allowed to claim the per diem rate for meals only, but you have to actually claim the actual cost of lodging. If you are an employer who is reimbursing your employee for the cost of travel, you can give your employee the full per diem rate. The employee can spend more than that, spend less than that. If they spend more, they pay the difference. If they spend less than that, they keep the difference, all tax-free to them. So this lodging rate is only for use by an employer who is giving a qualified reimbursement to an employee. It is not for a self-employed person to claim. So a self-employed person, however, does get the local meal rate. And this was Hawaii. And all the rates. Lanai is expensive. $116 a day for Lanai. That's the little island. All right. Yeah. All right. And then let's take a look for, I wanted to get some areas that are foreign. Yeah, here's the link for foreign rates. I clicked on that, and now I'm getting the foreign per diem rates. And here I need to click on a country. Let's pick England. That's the United Kingdom. I mentioned England earlier because they're hosting the Olympic Games shortly, which is all very exciting for them. And here's the UK. So let's go there. And then, of course, once I'm in here, now I have to select the date. And currently here in June, if we sent an employee or we were traveling right now on a business trip to London, England, let's find London. Here it is. It's still $180 a day. Right there. $319 for lodging. $499 combined. Whew. Expensive city. But it's not the most expensive, is it? Oh, I guess that is it. That is the highest one. Password number 2 is Aragorn. A-R-A-G-O-R-N. So at any rate, that's how you look up the per diem amounts. And when you're dealing with per diem and you've got someone who's traveling a lot for their business, those per diems add up really fast. Question coming up from Ralph. Are meal per diem subject to the 50% rule? The answer is yes, they are. When you figure the per diem rate, that per diem rate is going to be divided by 2. And I do have a question from Angie Wheatcroft. Don't firefighters fall under the 100% rule as well since they can't leave? Well, that would be, the answer to your question is when a firefighter is locked into their fire station and they're not allowed to leave, that would be an illustration of a meal expense that is at the convenience of the employer. Whether the employee can deduct it, I haven't had a chance to look up firefighters. I've not had a client as a firefighter ask me that question. So I know that the employer could certainly give the firefighter a free meal. The question is, can the firefighter get a deduction for his meal? that is not subject to the 50% limit? That I don't know. If you can find it in writing somewhere, let me know. Yeah, city pays for the food is what I'm hearing in my classroom, and the answer would therefore be the city is able to give that as a tax-free fringe benefit to the employee. Now, what about the per diem rate when on the days you are leaving or returning home? For travel days to and from home for a business trip, you must prorate your standard meal allowance, and you can do so by one of two methods, both of which are not half bad. Method number one, you get 3/4 of the standard meal allowance. Well, if you leave at 1 in the afternoon and return at 2 in the afternoon, you'll get 3/4 of a day for both of the days that you're traveling. That's actually more than a day. That's a pretty good deal, right? So that's a fair deal. I'll go for that. Or method number two, you can prorate using any method that you consistently apply that is in accordance with reasonable business practice. Well, how would I look at that? Well, let's suppose I catch a red-eye flight that leaves at 5 in the morning and gets to the work location, you know, by what, I guess if we're going from Pacific Coast to East Coast or whatever, but I get there around 9 in the morning. And then I'm there all day, and I catch another flight back, but I'm not actually gone 24 hours. Am I going to be able to claim the entire day even though I wasn't gone 24 hours? And I would say sure. So method number two would be an example like that where you could say I was gone for every meal of the day. Can't I claim every meal of the day? And I would say that seems reasonable. 50% limit on meal and entertainment expenses. Whether you claim your actual expenses or the standard meal allowance, you may only claim 50% of your allowable expenses, except if you are a transportation worker working under the hours of service limits. If you are, you can deduct 80% of the business-related meals. If you incur those meals, well, you are subject to the Department of Transportation hour of service limits. These limits generally affect airline pilots and flight attendants, train conductors, and interstate truckers. In addition to being allowed to claim the 80% of meal expenses, workers who are subject to hour of service limits are allowed to use higher daily rates than the $46 rate allowed for non-transportation workers. Now, we have two columns here for the amount from 10/1/2010 forward and the amount for 10/1/2011 forward, and you can see there's no change. As I said, there has been no change for some time ever since the recession hit, but for a long time they were going up by $1 or $2 a year. But at any rate, if you are working in the transportation industry inside of the continental United States, the rate is $59 a day. Outside of the United States, it's $65 a day. And you can, of course, still track if you're in high-cost areas. But, I mean, most of the time when you're traveling, you're not in a high-cost area. You're between high-cost areas, right? You're in the air or over the land or whatever. And so actually figuring out how long you were in a high-cost area and working all of that out could be rather nightmarish. So the rate that they're giving you is less than that for most high-cost areas, but it's more than that for the country as a whole, and they're saying go with this number. Now, does this add up to be a lot of money? The answer is, well, yes, it does. When I do truckers, and I've had a number of truckers over the years, they're usually gone a long period of time. Now, the thing with a trucker is they're required to track how long they're away from home. They're allowed to, they are required to keep a log that shows where they were on the road every hour of every day that they're on the road. And so if you look at a trucker in the eye and say, how many days you're on the road, they'll say, let me go get my log. And they go out into the car and they get their log and they come back in and they'll give something like, I was on the road for 220 days last year. So you go, wow, that's a pretty big number. And I'm going to take that number and multiply it by the per diem rate for truckers, which inside of the continental United States, a trucker gets $59 a day. So if I go $220 times $59 a day, that's a big deduction. That deduction comes out to $12,980. So $12,980 deduction. Now, because this person is a transportation worker, they're actually going to get 80% of that number as a final deduction. So I'm going to multiply that by 0.8, and I get the final deduction they're allowed to claim on their tax return. All right, so truckers are gone a lot. Those long-haul truckers, they're gone a lot. They're a lot of times they're not even home that many days. 220 days on the road means they weren't on the road over, for 140 days in the year, and most truckers are gone closer to 300 days a year. So, yeah, truckers have big deductions coming to them, but it's not just truckers. If you can show you're working under hours of service limits and you are working on a train, like a train conductor, or you're a flight attendant or a pilot, you may be able to get those. Now, of course, when you work for airlines and so forth, it is very often the case that the airline is giving you a per diem tax-free already. So clearly, there are certain occupations that may have lots of hours but very small expense because they're already being reimbursed for it. But truckers usually are not reimbursed, and they're the ones that I typically see with these big amounts. Now, while we're on the topic of truckers, I thought I would also bring up the Amtrak Act. It's not something I see or hear too much about outside of Oregon, but Oregon, oddly enough, has made a point of educating taxpayers in Oregon about the Amtrak Act. It's not an Oregon law. It's a national federal law, but in Oregon, they make a big point of making us learn it. And so because we're so familiar with it here, I'm going to explain to you what it means. The Amtrak Act, the Amtrak Reauthorization and Improvement Act of 1990 became public law, and it prohibits states and local governments from taxing compensation of certain non-resident employees who have regularly assigned duties in more than one state. If you are a federal, state, or local government employee, you may not exclude your income under the Amtrak Act. U.S. Postal Service employees are considered to be employees of the federal government. So who does qualify? Well, to qualify under the Amtrak Act, you must work for an interstate railroad or an interstate motor carrier or an interstate private motor carrier. If a qualifying employee of an interstate motor carrier or private motor carrier must, I've got a tongue twister here, directly affect the safety of a commercial motor vehicle. And they go on to talk about what that means. And they say it means you are required by your regularly assigned routine and duties to work directly with the commercial motor vehicle or its contents. The duties must be of a direct hands-on nature that requires you to physically move, touch, or affect the vehicle or its contents, and supervisory, managerial, consulting, or other duties that indirectly affect the safety of motor vehicle but do not meet the definition of directly affects. And then you must also work as an operator of a commercial motor vehicle, a mechanic, a freight handler, or someone other than an employee who directly affects the safety of a motor vehicle. So then they go on to define motor vehicle. Well, why are we talking about this? It is a federal law, and what the law is saying is that if you are, for example, a long-haul trucker, and you are working, and you drive your truck from Portland, Oregon to St. Louis, Missouri, how many states are you going to drive through getting there? And if you're being paid while you drive through each state, does that state have a right to tax you for the hours you worked while you were driving through that state? No, because of the Amtrak Act. But before the Amtrak Act, the answer was yes. And if you're not an interstate transportation worker covered under the Amtrak Act, technically speaking, if you travel to another state and you work in that other state, that state has a right to tax you. So it's a rather complex issue. A lot of preparers don't stop to think about. Okay, I have a client who says they took their business and they went and worked in, did some consulting work in Arizona, and normally they live in Nevada. So their tax home is Nevada. They went to Arizona and worked for a few weeks there on an assignment, and they earn money. Is Arizona going to want a piece of that? The answer is yes. There's going to be a filing requirement with the state of Arizona, and pretty much any state out there has those requirements, but something that tax preparers don't often think about is outside the boundaries of the state that they're in. I've got a client who came in to do their federal tax return. They came in to do the state tax return of the state that I'm working in. Is there a requirement to file a return for any other state? And the answer is if they worked and performed services in any other state, yes, there is a requirement, and the only exception to that is the people who fall under the Amtrak Act. Okay, the next category of expense we're going to look at is entertainment, and after we finish talking about entertainment, we will take a break. So entertainment expenses are similar to meal expenses in that the 50% limit applies to them. You can deduct ordinary and necessary entertainment expenses provided they are directly related to business or associated with business. Directly related to business. To be directly related to business, all of the following must be true. You expect to derive income or some other specific business benefit other than goodwill at some time in the future, but it is not necessary to demonstrate that you actually receive the benefit. You actively engage in a business meeting, discussion, or other bona fide business transaction with the person whom you are entertaining. Your principal purpose of the combined business entertainment activity is the active conduct of your business. but it is not necessary to devote more time to business than to the entertainment to meet this requirement. Now, if you can't meet the directly related test, maybe you can meet the entertainment is associated with business test, and that would be okay. If your activity does not meet the directly related test, it may still be deductible if it satisfies two conditions. The activity has a clear business purpose, or the entertainment directly precedes or follows a substantial bona fide business discussion. So it needs to have a business purpose, and it has to immediately precede or follow a substantial business discussion, generally within a 24-hour period, however circumstances can allow otherwise. So examples that Publication 463 gives about this type of expense. You have a meeting with a client who's flown in from out of town, and you have the meeting at your office. And after you have the meeting at the office, you take them to a football game. Now, the football game, is there a purpose to it? Well, yeah, I'm entertaining my client after we had a substantial business meeting. Is it deductible? Yes, it is, because it has a business purpose, and it can be closely associated with as either immediately preceding or immediately following a substantial business discussion. Now, let's suppose we don't have a meeting at the office. The only thing we do is greet at the airport, get in the car, and go to the football game, and then I take them back to the airport again. Is that going to be allowed? And the IRS looks at that with a little bit of question, because can you actually conduct a substantial business discussion at the game? Not when a roaring crowd. It would be difficult. But maybe you did it in the car on the way there and the way back. So they're going to be asking questions like that. Does it seem reasonable? Now, if you have a business meeting with a client in a quiet restaurant where you can have discussions in a quiet environment like that, then you would have a directly related test being met, because it's possible to have the discussion and the meal simultaneously. But in an entertainment facility like a noisy game, you'd be looking more for the associated test. And I see a question here, Todd, second password. There has not been a second password yet, so we must be getting close. So coming back from break, I've realized we've got 2 hours left in the day and lots of content, so I'm going to have to pick up my pace. That's the way it usually works with me. I think I've got lots of time, I'll talk about everything, and then no, I don't. Okay, so the next item in line that we come to on Schedule C is line 25, where we talk about utilities. Enter on this line the cost of gas, electricity, trash, water, heating oil, and telephone. However, you may wish to list telephones as a separate expense on line 48. That's just my personal preference. Somehow I don't think of telephone as being a utility. I think in the olden days when you had a telephone line that came into your building, it was like a utility. It was a monthly bill. But these days with cell phones, it's such a variable thing, and you're supposed to be separating out business use on it. I personally just pull telephone out, but IRS says it is okay to stick it on this line. Line 26, wages. Enter total salaries and wages you paid to employees for the year. Do not include salaries and wages deducted elsewhere on your return, such as under cost of goods sold, or amounts paid to you. Reduce your deduction by any wage credits that you claimed. Employee. Your employees may include your spouse and children or any other person whom you hire to work for you in your business. If you provide compensation to your employees during the year, you are subject to additional reporting requirements, and we will talk about those at the end of the class today, in brief, not in detail, because that would be a whole class on its own. Line 27, any other expense. Well, it's a line where if we haven't already covered it, list it here. And I've noticed a lot of tax preparers don't bother using any of the pre-allocated lines and just list everything on line 21. I do make an effort to use the lines that are offered. But examples of items that really don't seem to have a line are, well, internet access. I suppose you could stick that under utilities, but I just like to know certain things by themselves. Subcontractors, well, there is a line for sort of stuff like that, but it depends. It's okay to stick them there. Sometimes I like to be really precise. Photo production costs would be another example, but you might put that under materials. But if you're paying someone, like if you're a photographer and you're paying a lab to develop some pictures, where would you put that? Well, the other expense line could work. So those are just some of the things I've put on the line over the years. Could you put those expenses on some other lines? Probably. Does the IRS really care? No. Yes, seminars is a good one. Line 28. On this line, you enter total expenses before business use of home, and then on the next line, you figure your tentative profit or loss. After you have figured your tentative profit or loss, now it is time to move on to figure your allowable deduction for business use of home. And that's going to be the next topic of the day, which is Form 8829. A couple of other things to mention before we get there, though. One of which is line 32. If you have a loss, check box A or B. If all of your investment is at risk, you will check box A. At risk means you have money to lose. In other words, the money that was lost was your money. It came out of your bank account, or you sold your property and put the money into it. It was your money. Or you used your credit cards and you're on the hook for your credit cards. That means you're at risk. If you're only somewhat at risk or not at risk, it would be because the money spent was not yours. If some or all of the operating capital came from outside investors or from non-recourse loan, then you may not be at risk, or you may only be partially at risk. And if you are only partially at risk or not at risk, then you're not allowed to claim a deduction for your losses to the extent you are not at risk. IRS has a form for figuring the amount to which you are not at risk called Form 6198. We talked about Form 6198 for quite a while in our class on passive activity loss limits and rental property, but we're not going to talk about it any more than that today. Schedule C, Part 3, is where we enter cost of goods sold. Cost of goods sold, it goes hand in hand with manufacturing and retail businesses. Most service providers do not work with cost of goods sold, nor do they ever deal in cost of goods sold. But if you are in manufacturing or retail, it really is your business. And if you are in manufacturing or retail, you do need to track cost of goods sold. There are some exceptions to it. And here is an example. You operating a heating and cooling business. Your gross annual receipts are under $1 million. If that is the case, you can choose to claim the cost of a furnace you are selling and installing for a customer by deducting the furnace as a supply on line 22 of Schedule C rather than factoring it into cost of goods sold. However, you may only claim the cost of the furnace as an expense in the year you sell it to the customer. You may not claim a deduction for the cost of a furnace you bought but have not yet sold. So most businesses are required to track inventory, and they give an example here of someone who does not have to track inventory because his business is under $1 million. And the type of business he's doing is really more service-oriented or installation-oriented. So how could it work that he wouldn't be allowed to deduct the cost of the furnace? Well, let's just suppose you're a furnace installation and repair business. And in December, you sign off on a job to install a furnace. And your customer gives you a deposit. You order the furnace arrives, and you pay for the furnace in the month of December. But you don't get out and finish installing it in the customer's place until January. And so that's when you bill the client is in January, and that's when you get paid for it. Well, IRS says you're not going to be able to deduct that furnace as an expense in the earlier year because you still owned it, and it was still on hand. You're going to need to show it only in the year you actually dispose of it with your customer. It is recommended, whether you're using inventory methods or not, that you still have to keep track of your cost of goods sold. And in general, the cost of goods sold method is the most accurate method of tracking your overall income and costs. So we're moving on to the next part of Schedule C. We're looking at Part 3, cost of goods sold. And you can see that it's a multi-line section. The first line is, what method are we using to track inventory? Cost, lower of cost or market, or other. And if it's another, they want you to attach an explanation. Line 34 is asking, was there any change in determining quantities, costs, or valuations between opening and closing inventory? If the answer is a yes, you have to account for that difference in your opening. Line 35, you enter your closing inventory for the year before is your opening inventory for the new year. So the 2010 ending inventory should be equal to the 2011 opening inventory. That's what we should be looking for. The only reason there would be a difference is if there was a change in how we track inventory, and then we adjust for that with the opening inventory in the new year. Then on line 36, we enter purchases less cost of items withdrawn for personal use. On line 37, we enter the cost of labor that do not include any amounts paid for yourself. So if you employ a workforce and you have cost of wages, there's really technically two places you can enter that on the tax return. One is on line 37 as a cost of labor, and the other is on the front side of Schedule C as a wage expense. If you incur the labor in the cost of manufacturing or selling a product, then it should be here under cost of goods sold. Then we have a category called materials and supplies. Any other costs that you might have paid, and in the past I've looked up what IRS says another cost is. IRS says the cost of shipping product in is an other cost, but not the cost of shipping out. Well, there's a question, how do you account for spoilage? Well, it's very simple. At the beginning of the year, I have a certain amount of inventory on hand. During the year, I buy more inventory. And at the end of the year, I have a certain amount of inventory. And if I have spoilage, that inventory has been thrown out. So it's not in the closing inventory. Therefore, it's accounted for in the fact that, well, it's not there anymore. So the closing inventory is where we account for stuff that's spoiled or shoplifted or disappeared. It's really where it happens. So most people are required to keep inventory, but there is a couple of categories of people who don't have to keep inventories, and they both have to do with small business. In general, you're considered to be a small business, not required to track inventory if your gross revenue is $1 million or less, averaged over the last 3 years. And if you've only been in business for less than a year, you can do a pro rata average for the year that you have been in business. And there's a whole bunch in here on inventory. I could spend an hour talking about inventory, but I think I'll just leave it to say that inventory is an important system. You need to account for it on the inventory section of Schedule C. You have the opening inventory that in most cases should be the same as the preceding year's closing inventory. And the other part about inventory is most small business owners are not terribly good at keeping track of their inventory to begin with. So who do I have that I ask for inventory? Most of the time it's restaurant owners. How much inventory did you have on hand at the end of the year? That's going to be beer, wine, napkins, food on the shelf, dry goods, stuff that can spoil. What was your inventory? And well, of course, they're seeing me in April, and the inventory that they count they should have done was in December or January. So, well, have things changed that much from point to point during the year? They do the best job they can of going and figuring it out, but a proper inventory control system means that you're going through and you're counting everything. And you're seeing how many you have of each item, and then you're supposed to allocate or determine what method of evaluating your inventory that you are using. Types of things that you include in inventory are merchandise or stock in trade, raw materials, work in process, finished products, and supplies that physically become a part of the item that is intended for resale. Also wanted to point out the uniform capitalization rules. The IRS talks about this quite a bit. It's something that specifically applies to farmers, but it also applies to other businesses. Under the uniform capitalization rules, you must capitalize the direct costs and part of the indirect costs for production or resale activities. Include these costs in the basis of property you produce or acquire for resale rather than claiming them as a current deduction. You recover the costs through depreciation, amortization, or cost of goods sold when you use, sell, or otherwise dispose of the property. So let's think of something that you might manufacture under the uniform capitalization rules, or how they would apply. Earlier I described a little bit about manufacturing a photocopier, and certainly in a big operation that would go on, wouldn't it? You have all of the materials that have to get brought in. They have to get shipped in. So you're paying for shipping, you're paying for the raw material to get shipped in. In addition to that, you're paying for the assembly line that it is built on, and you're paying for all the labor, you're paying for all the employee benefits that go with that labor, you're paying for the utilities, you're paying mortgage lease on the building. And under the uniform capitalization rules, all of the costs associated with that have to be accounted for and factored into cost of goods sold. And you don't write them off until the inventory is sold. So it's obviously a very advanced method of accounting, far beyond the capacity of most small businesses, which is why most small businesses involved in manufacturing don't have to do it if they're under $1 million. But it is more accurate and something that IRS does want them to do. Now, in fact, the uniform capitalization rules are so complicated that although most businesses under $1 million don't have to keep track of inventory or report cost of goods sold, the uniform capitalization rules are not enforced on a business until it's grossing $10 million. So that's a pretty good sized business before they're coming in enforcing it. There are ways to account for inventory. There are a number of different things that the IRS would like you to look at when you are looking at factoring inventory, and it has a number of different places you can go to read about that if you care to, none of which I'm covering in today's class. But for example, amortization, if you want to read more about that, we did cover that in our class on Depreciation Made Easy. That's discussed in Publication 535. Bad debts, those are discussed in Chapter 10 of Publication 535. Depletion is discussed in Chapter 9 of Publication 535. More on depreciation in Publication 946, and installment sales are discussed in Publication 537. So all of those can factor into inventory rules and can be read about. Now, most of the information I've got on inventory here came from publication 334. So the information I'm relaying to you in today's class, most of that is nicely summarized in publication 334, and you can go there to read about it as well. The next line on the form under cost of goods sold is the method used for valuing your closing inventory. You may use whichever method of valuing inventory provides the lowest value. However, if you use the cash method of accounting, you must use the cost method for valuing your inventory. There are 3 methods available for valuing closing inventory: cost, lower of cost or market, or retail. You must value your inventory at the beginning and end of each year to determine your cost of goods sold. To determine the value of your inventory, you need a method for identifying the items in your inventory and a method for valuing these items. Inventory valuation rules cannot be the same for all kinds of businesses. The method you use to value your inventory must conform to generally accepted accounting principles for similar businesses, and you must clearly reflect income. Your inventory practices must be consistent from year to year. And of course, earlier in the day, I talked about my client who runs the clothing business, and his bookkeeper thought that, you know, we should switch accounting methods so that it didn't make him look like he earned so much money. You are absolutely not allowed to change inventory methods to change your income. The inventory method can change for legitimate business reasons, just for efficiency of running the business, or if you find the method you've been using is not terribly accurate, so you want to move on to a more efficient system. Those would be valid reasons for changing. The last reason that the IRS would ever agree to let you change your inventory method is it gives you some tax advantage, because the tax code says you are going to pay tax on your profit, and you can't make your profit look like it's different than it is. Line number 34, was there any change in determining quantities, costs, or valuations between opening and closing inventory? A change in the method used to determine inventory values usually results from a change in the method of accounting, such as last in, first out to first in, first out, and then refiguring last year's inventory using the new method and entering the result on line 35 and attaching an explanation. Line 35, inventory at the beginning of the year. Your opening inventory should be the same as the closing inventory for the prior year, unless this is your first year in business. Line 36, less cost of items withdrawn for personal use. So the cost of purchases minus anything you used personally, that is the amount that you enter on that line. Line 37, cost of labor, but do not include any amount that you paid yourself. Line 38, materials and supplies. Include on this line supplies you use to manufacture your product. For example, food by a restaurant or materials by a production line. And on line 39, other costs, enter other costs relating to cost of goods. Include the cost of shipping inventory items in, but not include the cost of shipping inventory items out. On line 40, you add lines 35 through 39. This is your total cost of goods for the year. And then you subtract out the year-end inventory to arrive at the final number, which is your cost of goods sold. The final section on Schedule C, Part 4, we're at the very bottom of page 2 of Schedule C now, where we enter information on the vehicle. And at the start of class today, I said we would be returning to this point, talking about it a little. This is a section where you have to be concerned as a tax preparer about whether or not you're meeting the reporting requirements. Now, if you are electronically filing return and you have not filled out the vehicle information correctly and you have a number on line 9, the tax return will reject. It just simply won't go out. But if you're filing a paper return, it probably is possible to get a paper return out and accepted by IRS that is incorrectly reported. The correct method of reporting auto expenses is you enter the allowable auto expense deduction on line 9 of Schedule C, and then you have to provide information about the usage of the vehicle. There are 2 places that you can do that. One is in Part 4 of Schedule C. You can see that it provides you with a place to enter the date that the vehicle was placed in service, the number of business miles driven, the number of commute miles driven, and all other miles driven. Then it asks a series of questions. Was the vehicle available for personal use during off-duty hours? Do you or your spouse have another vehicle available for personal use? Did you have evidence to support your deduction? And if so, is it written? Those are questions that need to be answered and not left blank. If you have more than one car, the IRS says to attach a statement that includes all of the same information. But also read this segment up here. I've got it highlighted. Complete this part only if you are claiming car or truck expenses on line 9 and are not required to file Form 4562 for your business. So 4562 is the depreciation and amortization form. And how do you know if you're required to file the form? Well, obviously, you need to know all the rules associated with that form. If you are required to file the form, You do not enter any auto expense information other than the expense deduction on line 5. So you would leave part 4 blank on Schedule C if you are required to attach Form 4562. And on 4562, you would enter all of the same information that you could have entered on page 2 of Schedule C, including the business use percentage and answers to those questions. Do you have a vehicle available in your off-duty hours? Was the vehicle used primarily by a more than 5% owner, and so forth? So those questions have to be answered either on Schedule C or on Form 4562, and you answer them on 4562 if 4562 is required for other reasons. Other reasons why Form 4562 is required is you have listed property in use in the business. If you have any listed property in use in the business, the form must be attached. The other reason the form must be attached is if you have a carryover of a Section 179 deduction, or if this is the first year you have placed a new asset in service in your business. Part 5, other expenses. So on at the bottom of page 1 on Schedule C, we came to a point where you enter other expenses from Part 5, and that's where we are now, is the point on the Schedule C where you enter those other expenses. And some of the expenses that I've just kind of put on a dummy version of the form here are internet access, subscriptions, continuing education, website design. Could website design go under advertising? Probably. Does it matter a whole lot? No. But when my clients give me a P&L and they have numbers on it, I like to put them in places they're easy to track, because if I don't, then they call me and they say, where did this number go? Where did you put that number? An IRS auditor would probably like to see a number that's easy to find too. Business expenses and the $25 limit. I'm talking about this here because this is an example of an expense that would go on the other expense line. There is no gift line, is there? If you look at Schedule C, there's no place where you enter gifts, so it seemed to me that's an item or a deduction that would get entered there. There is a rule about gift expenses. The maximum gift deduction you can claim in any year for any gifts given to a single person is $25. So if you have a client and you want to give them tickets to the football game, they're going to have to be nosebleeders. Because if you go over $25 of gift in the year, you're not allowed to deduct the excess. You can go up to $25 but not more. IRS says that a gift to a family member of your customer is the same as giving the gift to the customer, and that $25 limit still applies. The only exception to the $25 rule is an item that had a cost of $4 or less and has your name clearly and permanently printed upon it, and is one of a number of identical items that you widely distribute, such as pens, desk sets, and plastic cases. Also, signs, display racks, or other promotional material to be used on the business premises of the recipient do not fall under the gift rules. But pretty much you buy your client a gift, you have to be concerned with the $25 gift rule. It's not to say that you can't give them more than $25 worth of gift, it's just your deduction is limited to that. So I have an illustration here. We have Mike, who is a business client. You gave him a gift valued at $15. Then there's Mike's wife. You gave her a gift also valued at $15. Then you have 4 members of the staff of a corporate buyer, and you gave each of them a gift valued at $25. And then finally, you gave Janice, a business client, a gift valued at $75. So the total amount you paid for gifts during the year is $205. What's your deduction going to be? Yeah, the total deduction is $150, and I actually have the answer here in a little sideways box for you to help you cheat your way through. But we're going to go look at Mike and his wife as being a single gift. $30, he will not be allowed to deduct 30. He will be allowed to deduct 25 combined for those two. So it'll be 25 up here, plus 100 for the 4 staff members, plus 25 down here, and that's where we get 150. Next item that would go on that other expense line is work-related education expenses. To be deductible, your educational expenses must be required by your employer to keep your present salary, status, or job, or serve a bona fide business purpose, or maintain or improve skills needed in your present line of work. Now, if you're self-employed, can you deduct education expenses as work-related expenses? Well, I'm assuming that every person here who is in attendance in my class does plan on deducting the cost of attending today's class. That would be an ordinary and necessary expense required to maintain or improve your job skills, so it's completely deductible, and if you're self-employed, yes, you can claim it as a self-employed expense. There's a question, do you have to 1099 Pacific Northwest Tax School? Pacific Northwest Tax School is a corporation. You do not need to 1099 us. You can go to filinginoregon.com and find us. We are there. Okay. All right. Now, even if these above 3 tests are met, you cannot claim a deduction for your education costs if they are needed to meet the minimum educational requirements of your present trade or business, or they are part of a program of study that can qualify you for a new profession. Please note that it is possible you could be able to claim a deduction on Schedule C for an expense for education that might also qualify you for an education credit. You can do one or the other, but not both on the same educational expense. However, when you claim it on Schedule C, of course, you would be offsetting self-employment taxes, so Schedule C could be a good way to do it. And if you claim an educational credit for, say, $5,000 of expense or $4,000 of expense, but you had $10,000 of expense as the difference deductible, I see nothing that precludes you from doing a deduction on Schedule C for the excess. You just couldn't claim both in full on both forms. What expenses are deductible? Well, you can claim the cost of tuition, books, supplies, lab fees, and similar items, certain transportation and travel costs, and other educational expenses such as research costs, typing costs, etc. Also, transportation to and from school can be deductible. If you are going to school on a temporary basis, that is 1 year or less, you can deduct the cost of traveling from work to school and from school to home. If you are going to school for more than a year, you can deduct the cost of going directly from work to school only. Password number 3 is STOVOCOR, STOVOKOR, STOVOCOR. And that concludes session 20 of the basic tax course. You will not be leaving today's class with a classwork or a homework assignment since the lecture is not finished. Session 20 and 21 both focus on the manual that covers self-employment income and expenses. And at the beginning of session 21, we will do a review of the session 19 quiz, and then we will carry on with the remainder of our lecture on self-employment income. We will pick up with office use of home, and at the conclusion of the session 2021 lecture, we will give you the classwork assignment and finish up with sending you on with a homework assignment. But with that, we are finished with session 20, and I'll see you next time as we begin session 21. Bye-bye.